This is Bloomberg Markets. I'm Amber Kanwar with Shanali Basic. Time now for Stock of the Hour. Shares of Best Buy are rising today after the retailer said sales are starting to show signs of improvement this quarter. Now, we did still see sales fall more than 6% in the second quarter, but that was actually an improvement compared to past filings and the shallowest sales drop that we have seen in a year. Best Buy is also saying that they expect further improvement into the fourth quarter, expecting a decline of just 3% and maybe, Shanali, even the potential for a slight increase.
And joining us now to talk more about this is Anthony Chacumba, Managing Director of Loop Capital Markets. He has a buy rating on the Best Buy stock with a price target of $110 a share. Today, we stand at $78 a share. Anthony, what brings us to 110?
I think that to get from 78 to 110, what you have to see is an improvement in top-line trends. Best Buy's comps have been negative for the last several quarters. Now, a lot of that was the fact that you had this pandemic-driven demand pull forward into consumer electronics. A lot of that is the fact that inflation is quite high. But as you said, we did see sequential improvement in top-line trend in the second quarter, pretty significant. We're expecting to see a little bit more in the third quarter, and we might see growth in the fourth quarter. And so I think if we start to see that growth again, that's what gets the stock from $78 to 110.
What's the story at Best Buy now? There was a big tech sort of buying binge during the pandemic. The last year or two has been an unwind of that. Why own it here?
So I think it comes down to a few different things. First off, we did see, like you said, that demand pull forward. At some point, these products, I mean, there is a natural sort of life of these products. And so you're going to see a lot of those products that were bought early in the pandemic that are going to need to be replaced. The second thing is, regardless of what is going on with trends at any one given time, Best Buy is the lone remaining national dedicated consumer electronics and appliance retailers, right? So Radio Shack and Circuit City and HH Gregg, they're all gone. And that's a privileged position to be in. It's an incredibly well-managed company, generates a ton of free cash flow, pays a dividend, buys back stock. Even with the move today, the dividend has a nearly 5% yield. So I think that what you're really buying is the fact that at some point, it could be the fourth quarter, could be next year, you are going to see a normalization of consumer electronics demand trends, and that's going to be really good for Best Buy.
But what's the risk here? Because on the same note here, even though you see them increasing their adjusted EPS for the year, they did say that laptop TV sales were flat by unit terms. They did say that there's slight pressure from credit losses late in the year. What is the risk the consumer turns further?
Look, I'm not an economist. I'm not trying to play it on TV. But, look, clearly if the macroeconomic environment gets worse, that would be a negative for Best Buy, given the fact that they do sell high ticket discretionary items. But that's really the most significant risk I see for Best Buy at that time. And I think that's more than discounted in the stock price at current levels.
You cover a lot of retailers, many that have reported over the last week or two, and a lot of them are complaining about shrink and theft. Is that a problem at Best Buy, or are the things just too big to steal?
I think it really comes down to that. These items are just too big to steal. You can't do kind of the, smash and grab like you can at a lot of other, retailers, or it's not easy to, do the five-finger discount, stick something in your pocket or in your purse. So that was definitely a positive, is that Best Buy is not having anything close to the shrink issues that are plaguing a number of retailers that I cover.
How are you as an analyst dealing with this issue of shrink? I mean, it's a tough one to model, but it's meaningful, right? It's showing up in the bottom line.
Absolutely. Look, just to be clear, shrink is not a new thing, right? It is sort of a cost of doing business in retail, but we have seen this increase since the pandemic. We've spoken to some of our industry contacts. A lot of it, quite frankly, it has to do with a lack of consequences. In other words, a lot of these retailers are specifically telling their store employees, and rightfully so, if you see somebody stealing stuff, don't try to confront them. Don't try to manhandle them them or anything like that. Just kind of let them get out of the store. But more importantly, even when these people are being caught, local law enforcement is just not really doing much, to prosecute them until we see, consequences, quite frankly, of shrink. It's really tough to see, how it comes down. Now, the other thing retailers can do, which is in their control, is they can put in more kind of shrink prevention measures, whether that's, putting products, in lock cases, so forth and so on. The problem there is that you can negatively impact the customer experience of the vast majority of your customers who are not there, for the 5-figure discount, who are actually there to legitimately buy the products.
Between the fundamentals themselves, the numbers they put forward, as well as the idea here that you can't steal TVs as easily, there are reasons that Best Buy, of course, is rising. But when you look across your universe, Anthony, who's winning the quarter now that we're drawing to a close?
Yeah, that's a great question. I mean, to some extent, I think Best Buy sort of won the quarter, to be perfectly honest with you. I mean, we've seen very, very choppy results by a number of retailers. In some cases, we saw retailers that missed numbers. In some cases, we saw them beat numbers, but the stock still went down. I mean, these are definitely some of the more solid results that we've seen. Now, we do have a few other retailers that are still going to be reporting just even later this week. I think that Ollie's Bargain Outlet was likely a winner this quarter. I think we're going to see good numbers from them, but it has been a very, very choppy quarter.
Our thanks to Anthony Chakamba of Loop Capital Markets. Hurricane Idalia is gathering force in advance of making landfall on Florida's west coast, where it could dive a deadly fall of water onto the shoreline, snap trees, and cause widespread power outages. We'll have the details up next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
This is Bloomberg Markets. I'm Amber Canmore with Sonali Basak. Now it's time for today's For What It's Worth. $15 billion. That is the damage that Hurricane Idalia could bring as it barrels towards the Gulf Coast right now. Now, as it swirls above warmer temperatures, it could become a Category 3 hurricane by the time it makes landfall. Officials are warning that it could produce storm surges of 10 to 15 feet. We're also going to be watching for how two commodities could be affected, oil and oranges. However, as of right now, Sonali, it is expected to stay away from offshore oil and gas production as well as key orange groves.
Certainly, and we did see, however, that estimate for losses increase over the last day from 10 to 15 billion. Flights have been canceled at Tampa International Airport, and rain is going to be spreading through Wednesday through Florida. It's unclear how much it will hit those key cities. For Amber Kanwar, I'm Sonali Basak, and this is Bloomberg.
About your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Stocks up, yields down. Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the U.S. And we're going to take a look at the market first, because we are looking at stocks well in the green. We're looking at a bigger rise in the S&P than we've seen in the last couple of days, 1.2% higher on the S&P 500. The NASDAQ 100, an even bigger gain, almost 1.9% as we head into the close. The 10-year yield cooling cooling of the yields. We're looking at an 8 basis point decline, almost 9 basis points to 411. These are the lowest levels we've seen in about a week or so. Bitcoin on the rise, up more than 7% after that grayscale court decision has come out today. A lot of uncertainty ahead for the asset, but certainly a positive signal ahead, a path forward, if you will, for Bitcoin. So all risk assets on the rise, Katie.
And of course, it's not just Bitcoin that's rallying on the heels of that grayscale decision. You have cryptocurrencies across the spectrum. We're talking about Ether, Binance Coin, etc. They're getting in on the action, while Coinbase, the largest U.S. crypto exchange, higher by double digits. We're going to speak with Mizuho's Dan Dolev in just a bit about whether that rally is justified. But zooming out, as Shanali mentioned, you have risk assets broadly off to the races today as traders dialed back their bets on further Fed tightenings. You have Treasury yields plunging right now, while the S&P 500 is on track for its first back-to-back gain this month after another round of dovish jobs data just this morning. We had U.S. job openings fall to a 2-year low in July, while the so-called quits rates also dropped. But Shanali, of course, the JOLTS report is just one of several economic data points that we're keeping an eye on.
It sure is. Let's talk a little bit more about those vacancy data, because as you say, it's one reason we are seeing the cooling of interest rates here, cooling of yields. We're looking at, for example, here, 8.82 million openings here. That was 9.2 nearly. And you're looking at the quits rate at the lowest level since 2021, early 2021. This is a significant signal of a cooling of a labor market ahead of a very highly anticipated jobs report on Friday, Katie. There's another thing about the consumer, though, and I want to flip up the board here and talk about consumer confidence, because this consumer confidence data came in below every major analyst estimate, so much cooler than what was expected. Now, it's not uber low. However, it is significantly low. We are looking at a reading here that is certainly on the decline. Let's see if that keeps holding.
And let's get into it now with Mark Kudzel. He is PIMCO Portfolio Manager for Liability-Driven Investment. Mike, it's great to have you with us on today, because you look at the reaction in the bond market, looking at 2-year Treasury yields down by about 16 basis points so far. It felt for a while that we were looking at a one-way trade when it came to the Treasury market. Yields higher. Is this a dynamic shift right now, or do you think that there's more of a sell-off to go in the Treasury market?
Hey, great. Thanks for having me. I think when you look at the Treasury market, just taking a step back for a second, yields are as attractive as they've been in 15 to 20 years. Whether it's nominal yields as attractive as pre-global financial crisis, or real yields attractive they've been in 20 years, these are opportunities you haven't seen in quite some time. So certainly, if you just peel back the lens for a second, for an investor, certainly an exciting opportunity to be in fixed income. As it relates to today's rally, it just gives the Fed and markets a little bit more comfort that we continue directionally to move toward the Fed's objectives, which are lower levels of inflation, lower levels of growth, and this is just another piece of data that's moving there, and gives the Fed a little more comfort that maybe they don't have to necessarily hike again. Maybe they will, maybe they won't. I think the impact on asset prices will be quite subdued. It's really a function of how long they stay high, and whether or not they need to re-engage in a hiking cycle, or whether or not they're going to start cutting rates sometime next year.
Well, I do want to talk about the Fed, but I want to go back to your first point, that yields, if you look at them, they're the most attractive that they've been in quite a while. Where within the fixed income space, though, are you finding the most opportunity right now?
Yeah, I think there's something for everyone. If you're an investor that likes to stay in the front end of the yield curve, there are returns to be had on cash that you haven't had in quite some time. You can build a portfolio with very low duration at 6.5% or 7% yields. Those are equity-like returns with really very limited volatility. You can go further out the yield curve and get returns of 5.5%, 6%, and get capital appreciation and diversification potentially, if and when yields do fall. So I think it depends on the investor and your whole overall portfolio allocation, but something for everyone in fixed income. It's really an exciting time.
Curious to get your thoughts on the data, Mike, because if you look at the Conference Board data on consumer sentiment, you're looking at a reading that was the biggest drop in 2 years. You're starting to see interest rates start to bite at the consumer. But the question is, how much more does it bite into the consumer into next year?
I think that is a very important question, and one we're going to get some more data going forward. This is just a piece of data. If you saw the first 2 quarters this year, the U.S. grew at a rate above potential, and certainly showed a resilient economy due to kind of high levels of savings, a consumer that may be a little bit less responsive to higher rates due to fixed rate mortgages. But at some point, yeah, these higher rates will matter. It's just a question of when these savings rates finally are depleted, if and when job openings translate to the drop in job openings translates to job losses and higher unemployment levels. And so ultimately, direction to travel is normalization. These consumer confidence levels are lower, but normalizing. The jobs openings data is lower, but normalizing. The inflation data lower, but normalizing. The question is, as we move forward to the fourth quarter with 4 or 5 quarters of higher rates, as we move forward with student loans turning back on, California tax payments need to be made. All of this will remain to be seen if it weighs on the consumer, if it weighs on the economy. If it doesn't, the economy, certainly more resilient. If it does, our base case at PIMCO is potential for a recession sometime in 2024.
The other area of volatility is the read-through across different types of rates, particularly mortgage rates. And if you think about the opportunity to invest in different types of fixed income securities, where do you fall in your views on the mortgage market, given how much of a surge we've already seen?
Yep, there's plenty of opportunities in fixed income, again, not just from a beta perspective, but from asset allocation perspective. And so as we look across the landscape, agency mortgages are an area that's really exciting to us. Some terrible technicals as it relates to the Fed running off their balance sheet $200 billion this year, as it relates to the FDIC selling some bonds that they've purchased out of banks in receivership. All that's led to valuations that you really don't see very often in agency mortgages, and it's an asset class we find quite attractive, and it's an asset class we're investing in across platforms at PIMCO. The other areas we find quite attractive are securitized products, AAA CMBS, AAA CLOs. These are assets that are senior in the capital structure, very well collateralized, and compared to other assets, namely generic investment-grade corporate credits, they out-yield generic investment-grade corporate credit. It's an opportunity to add resilience to portfolios, add yield to portfolios while going up in quality.
All right, Mike, that's a good place to leave it. Our thanks to Mike Cudzill of PIMCO. Thank you so much. Now, coming up on the close, how the latest report on U.S. jobs openings might influence the Fed's rate decision. We'll break it down next with Matthew Lazzetti, Chief U.S. Economist over at Deutsche Bank.
Plus, shares of Best Buy are rising as the company sees a potential sales turnaround in the fourth quarter. We're going to take a closer look at the numbers from the consumer electronics giant.
And we'll talk with Bindia Vakil. She is the CEO of ResilLink. Her insight on how to mitigate risks in global supply chains. All that and more coming up. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The top names in global leadership are on Bloomberg.
dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labour market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
Well, U.S. job openings fell in July by more than expected. The JOLTS report showed that the number of available positions decreased to 8.83 million last month, with the Northeast having the fewest openings of any region. Cooling labor demand is increasing speculation that the Fed will be able to pause its interest rate hikes in September. And let's ask an expert, because joining us on set, we have Matthew Lazzetti, Chief U.S. Economist over at Deutsche Bank. And it's great to have you with us, because for years now, the story has been that basically the labor market has been so resilient to the tightening that we've seen at the hands of the Federal Reserve. But when you think about the past few months of payrolls data, when you think what we learned this morning, is that narrative starting to change?
Yeah, so I think it's still early for that narrative to change. I think you still have a labor market that looks resilient. You know, we still have 3 million more job openings than unemployed individuals. You still have layoffs that are very low. You have job gains, which are, around 180,000 jobs on average. And so all that, I think, still really looks like a resilient labor market. Where I think the narrative is likely to change for the Fed is in how tight this labor market looks.
Mm-hmm.
You look at the quits rate, which has been this very good leading indicator for wage growth. It's basically normalized relative to where it was before the pandemic. We saw in another report this morning, the Conference Board, consumer views on the labor market are really starting to turn a little bit here. So I think it's still a picture of resilience, but also a picture of less tightness than what we've seen over the past several years.
Less tightness that we've seen, and let's marry this into the conversation about inflation, because that's, of course, been the head scratcher, how you have inflation cooling at the same time that the labor market remains so tight. When you think about the Fed's path back to 2%, how much less tight, if you will, does the labor market need to be?
Yeah, so I think Chair Powell has kind of given us the benchmarks for that. He says that we need to see wage growth that is close to 3%. Relative to the measures that we're seeing, which are all above 4%. Now, we could very well be in the vicinity of 3% wage growth over the next several quarters. So this labor market, I think, could very well be on the way to producing wage growth that is consistent with our 2% objective. I think the bigger picture that we've seen is you've been able to get inflation down materially so far without any pain in the labor market. And I think that can continue until we get to, call it 3% for core PCE. The real question for the economy will be, how do we get from 3% down to 2%? Will that require some weakness in the labor market? I think most likely it will.
There's another piece of the Conference Board data, expected inflation, that has ticked higher, edged up to 5.8%, first uptick in 5 months. That expectation of higher inflation paired with more payments that people are going to have to make, volatile oil prices, mortgage rates, and rents that are soaring. How much concern do you have about inflation shocks above and beyond what you've been seeing in the cooling of the data?
Yeah, I think the short-run inflation expectations in particular are highly tied to gas prices. So the gas price rise that we've seen over the past several months very clearly is showing up there. It'll show up in the CPI report that we get in 2 weeks' time. There we're expecting that headline inflation rises 0.6% month on month, so a pretty significant rise. You're right, the consumer's facing a lot of headwinds here. You have a cooling labor market, you have tightening credit conditions, you have rising delinquency rates, we have the return of student debt payments. We think that ultimately this does lead to a softer economy, one that results in a mild recession. But obviously we're getting mixed reports here. I think what today's data definitely tell us is we have more confidence that the Fed is done with their tightening cycle at this point.
Where is the brunt of the pain going to be seen when you look at the consumer market? You see rising delinquencies in credit card, auto. How much harder does that data get, and how much does that complicate the soft landing narrative?
Yeah, I think the market, certainly is in a mode right now where softer data is cheered on because it leads to lower interest rates. We've seen this big steepening of the yield curve this morning with the 2-year yield coming down substantially, and the market's taking that as a positive development because it is still a labor market that I think is resilient. I think we're going to really need to see that labor market data soften and weaken in a way where we begin to raise recession fears. I don't think you see that with this Friday's jobs report, but the recent trend in the data does raise some awareness around some softening that could be happening over the coming months.
I want to go back to a point you made that the Fed is done with its tightening cycle. What happens to the balance sheet? How motivated do you think this Fed is to keep running that down?
I think they are certainly motivated to run it down. I think that the signals that we got from Chair Powell at the July meeting were that they could continue to run that down, even in the context of cutting rates, as long as those rate cuts are coming with a soft landing environment. So under kind of the market's base case, I think QT can go through the end of next year.
Even if the Fed cuts?
Even if the Fed cuts, but only if they're cutting because of normalizing monetary policy. If they're cutting because we have a recession, and if they're cutting because the labor market's weakening and they want to provide accommodation, they will stop QT. So that's our baseline expectation, that it starts in Q2 next year, that it stops in Q2 as the labor market weakens.
All right, intent matters. Matthew Lazzetti, it's great to see you. Thank you for joining us. That is Matthew Lazzetti. He is Chief U.S. Economist over at Deutsche Bank. Now coming up, a potentially historic moment for crypto. Grayscale moving closer to launching a spot-based Bitcoin US ETF. We'll take a look at what it means for the wider industry, especially for Coinbase. That's up next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Coinbase is rallying in a big way after a federal court paved the way for the first spot Bitcoin ETF. Joining us now to discuss is Dan Dolev. He is Mizuho Securities Senior FinTech Equity Research Analyst. And Dan, let's start with the price action. I'm looking at Coinbase shares up 16%. Is that justified?
No.
No. Tell me why.
Yeah, let me tell you. I think today is just a very, very big short squeeze, right? And this is just an overreaction, and actually, it's a little bit of SEC's fault, I would say, because they've been going after every crypto thing, whether or not it's the right thing, and they've been attacking it. So it's being perceived by the markets. The loss of the lawsuit is being perceived as momentum for the crypto community against the SEC. So that's why the stock is up so much today.
And I mean, the narrative that I've seen floated for why this would benefit Coinbase, number one, it would be the custodian if this was converted to an ETF, the Grayscale Trust, and also that it could tap into another market. It would bring more people into the crypto space. More people trading would theoretically be good for a crypto exchange. What's your thought on the matter?
So I view exactly the opposite. I view it very differently. I actually think it makes, the custodian fees are actually a positive, but they're a fraction. We don't exactly know what they're going to be. Either way, they're going to be a fraction of the lost revenue from having fewer people trade on Coinbase. So basically what it's doing is creating more competition for trading in Bitcoin. It's commoditizing Bitcoin trading, and it takes the fees from, the 2 percentage points that they're getting today, eventually to zero.
Okay, zero is still, from 2 to 0 is still a long way to go. How long does it take, in your view, to compress so dramatically?
It's not going to be overnight. It's a good point. It's not going to be overnight. But I'm looking back at what happened to equities when Robinhood, which is another name that I like, went and offered trading for free. Everyone followed, right? Whether it's the Fidelities or the Charles Schwabs of the world, they all went. Basically today, if you want to trade equities, fees are zero. That's exactly where crypto is headed. So it's not going to be overnight, but I would say within 2 to 3 years, you're going to see massive compression in take rates on Bitcoin trading. And obviously, crypto trading, if crypto is still around outside of Bitcoin, which I question too.
Dan, you are one of 9 folks who are placing Coinbase as an underperform. There are 9 buys, 9 sells, 12 holds. Very mixed picture on the street on where Coinbase is going from here. Is there anything that would make you turn your view to positive?
I think, one thing I have to say is we were underperform, or as a neutral from day one, and then underperform when everyone else was, kind of cheerleading the stock. I think what could change our view potentially is if they pivoted away from a, crypto-focused app to doing more like a Robinhood, which is equities. So offer, just increase the breadth of their offering. Right now, they're just focused on crypto. And I personally think that crypto is a terrible asset class to be in. And they're so levered to crypto that eventually, hopefully, I think they'll hit our price target, which is $27.
And we'll see if that happens. We see shares right now currently trading above $85, so potentially a long way to fall. And I want to go back to the point you were making about why necessarily spot Bitcoin ETF approval would be bad for a firm such as Coinbase. Are you saying that retail investors would simply maybe buy the ETF versus trading on Coinbase, the platform?
Exactly, 2 reasons. One, they would buy the ETF in lieu of trading basically the Bitcoin itself, right? So it sort of commoditizes the Bitcoin itself, and it gives you opportunities to buy it elsewhere and have other exposure. The other thing, which is very interesting, and a lot of people are not thinking about it, a lot of people use Coinbase as a hedge against Bitcoin. If you have the ETF out there, it could actually be used as a hedge, and it sort of minimalizes the importance of Coinbase as a hedging mechanism against Bitcoin. That's an implication that a lot of people are not thinking about. Could be huge because a lot of the big hedge funds are using Coinbase as a hedge against Bitcoin. So it's something else that people are not thinking about as a negative.
It'll be fascinating to see how that shakes out. But just thinking about the different lines of business that Coinbase has, obviously, again, it's a crypto exchange. It makes its money off of trading and volume that we're seeing when it comes to trading. But you think about its function as a custodian. Say, for example, that Grayscale is able to convert into a spot Bitcoin ETF with Coinbase as its custodian. I believe it's listed as a custodian in some of the other active filings that are out. Could the custodial business sort of take the pain away from lower volumes?
You need a lot of custodian business to more than offset the fee, because the decline in volume. So, because the retail fees, and they've been increasing retail fees. Remember, in Q1, they've taken up retail fees on trading, and they've, which in my view is not fair, but that's what they're doing. You need a lot of it to fill the gap. And also, remember, if you are not the last mile to the consumer, you're losing a lot of your moat, and that's what happens. If they're the back-end processor or custodial, someone else is facing the consumer, that's a problem.
Now, you had also mentioned that you would want them to diversify before you were to change your view into equities. You mentioned kind of the reliance on the crypto industry. When you say crypto, do you mean the tokens that are so uncertain by the view of the SEC, or do you mean Bitcoin and Ethereum?
I think everything. I'm actually personally a Bitcoin bear. Can't help myself. I kind of side with Warren Buffett here, and I think there's a lot of issues with it. I'd rather own equities if I could, but so I think it's overall thing. I'm really worried. If you're asking where I'm really worried about, I'm really worried about the alternative coins, right? Because that's just a hodgepodge of tokens that are, there's no real scarcity value there. There's a bit of a scarcity value in Bitcoin, not in those tokens.
Do you think that some of these big asset managers, the BlackRocks of the world, change the narrative at all for Coinbase?
In the very near term, what you're seeing today, I think over the long term, it changes it to a negative thing because all the things that we've just talked about, right? Commoditization, losing the last mile relationship, fee compression. It just becomes a commoditized exchange, and that's a very hard place to be in down the road.
All right, Dan, it's great to speak with you. Really appreciate your time. That is Dan Dolev of Mizuho. And we'll be speaking with Grayscale CEO Michael Sonnenschein tomorrow at 10:45 a.m. ET on Bloomberg Television. You take a look at the markets right now. You can see that Coinbase, again, it's up almost 16%. You take a look at Bitcoin itself, up by 7.4% or so. We're still below $28,000. We're still below $30,000. Going to be interesting to see how that develops over the next few days. Don't go anywhere. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
This is Bloomberg Markets, the close. And President Biden speaking currently at the White House, giving details on his plan to lower Medicare drug costs to follow along, go to Live Go on your terminal. But given that it is 2:30 p.m. just about, we want to get a cross-asset check as we head towards the close of commodities markets. Bloomberg's Abigail Doolittle standing by with more.
So once again, Katie, we're looking at a tiny move for the Bloomberg Commodity Index. Right now it is up fractionally, but beneath the surface, as is often the case, we do have quite a bit of movement. New York crude, WTI crude, is up 1.3%, kind of really whipsawing around on the day. But right now it seems as though traders are going with the China stimulus and the idea that China is the world's largest user of natural resources and that maybe some of that liquidity will go into those natural resources. European natural gas, on the other hand, in contrast to yesterday and the day before when it was up about 20% over those 2 days on Chevron being told that two of its facilities that there would be a strike, 5% of the world's LNG capacity. Well, today, European natural gas is giving some of that back, down 8.4%, even though it seems like that strike is still on. Silver up 1.9%, similar to stocks. It's up for a third day in a row. And then finally, wheat simply can't catch a break, Katie. It's down 2.7%, down for a fourth day in a row. This is cheap EU Black Sea wheat is starting to, I guess, undercut Russian competition, but the idea is there's more supply out there.
So not great news for wheat, but one commodity that should be getting hammered right now is actually doing pretty well. Iron ore hitting its highest level in a month last week. That's in spite of deepening gloom over China's worsening property crisis. Let's get the latest now with Bloomberg's Joe Doe. And Joe, how much of the resilience that we're seeing in iron ore right now can we actually attribute to Chinese demand?
Yeah, absolutely. I think, China is more than 50% of global steel demand. It's more than 50% of global steel production. So if iron ore is holding up, that means something is holding up nicely in China. Obviously, the property sector, real estate, has been a sore spot for China since the reopening earlier this year. But you are seeing demand in some of the other sectors like automotive and appliances. And to tell you the truth, this isn't actually that different from what we're seeing in North America. Even just 6 months ago, I was at a huge construction equipment conference in Las Vegas, and there was a big worry that 4Q was going to be recessionary, right? That we were just going to see a massive slowdown. And just last week at the biggest steel conference in North America, the feeling had evaporated. Everybody feels like it's not going to be gangbusters going through the end of the year, but things have held up pretty nicely, maybe more than expected.
What are the risks that things turn around from here, given kind of the sensitivities the economy in China is facing right now?
Yeah, listen, if you're looking at $100 iron ore and you're betting that that's going to hold up or even go higher, I don't know that people would be going to sleep easy tonight or tomorrow expecting that to happen. I think the big concern does remain, right? You just haven't seen the kind of demand creep back into China that had been previously expected. We've seen these concerns in the copper market. We've seen these concerns in the aluminum market. Obviously, iron ore is just one of the many metal markets that we look at. But there is concern that things don't turn around, right? That the stimulus that we always expect out of China just really doesn't flow through, and that the property sector doesn't rebound immediately the way that people have always have expected it to, right? This is an economy that now is very mature. This isn't 2010s any longer.
Absolutely. We'll keep an eye out on all those risks from property to commodities. Our thanks to Bloomberg's Joe Doe. Now, China's biggest banks are getting ready to cut interest rates on existing mortgages again. It's part of another push by Beijing to stimulate the economy. And joining us now is Bloomberg's emerging markets correspondent, Sherry An. Sherry, when you look at the stimulus that has already been placed into the system, how significant is this move?
It's an incremental policy step, right? It's more targeted as well. What's really interesting now is that Bloomberg has learned that banks are ready to announce these cuts of rates on existing mortgages and deposits. Let's start with existing mortgages. Why is this interesting? Remember last week when commercial banks lowered the loan prime rate on the 1-year lending rate? That was not a lot. Those are for business loans, but for the 5-year, which affects mortgages, they didn't move and left it at 4.2%. We're thinking maybe they want to safeguard the banking stability. Well, these are more targeted measures. These are on existing mortgages right now, because even though they've cut benchmark rates and, okay, the mortgage cost has been reduced to a record low, that hasn't necessarily benefited these Chinese households because their existing loans don't get repriced until the beginning of next year. So JP Morgan's estimates now put, okay, mortgages right now on new loans stand at 4.18%, but that's 60 basis points lower than the outstanding borrowing. So we've had this rush of people trying to prepay their existing mortgages, even taking out short-term loans in order to do so.
So that's the impact when it comes to the housing market of these cuts. What are we expecting to see when it comes to the impact on banks specifically?
It's not going to be too helpful for them. Perhaps it's going to help in economic stability and people being able to repay those loans. But when it comes to the banks, it will hurt them from their net interest incomes to their margins and profits. So right now, the estimate from JP Morgan is, say, the entire mortgage loan book gets refinanced 60 basis points lower. Earnings at Chinese banks will be cut by 8%. Net interest margins also will narrow by 7 basis points. The expectation is not everyone will refinance their loans, but about 50% perhaps. And we have seen already the earnings from China Construction Bank, Ag Bank, China Merchant Bank, all posting weaker year-on-year net interest margins, despite the fact that they had higher profits.
Bring us cross-asset as well, because you did see some strengthening of the yuan. So what else does this mean, especially as we look forward to potentially more economic data and more moves out of Beijing?
Are we going to see more confidence in the markets is a key question, right? Because we have seen all of these moves by Beijing to shore up sentiment in the financial markets, even cutting the stamp duty for the first time since 2008. But those moves were really not sustained. We saw rallies and then they fizzled. Today, the yuan is slightly stronger. We have seen now the Golden Dragon Index trading at the best day in about a month or so. So maybe we will see a little bit more confidence. But the fact remains that economies keep downgrading the growth forecast for China. So we are now lower by the latest Bloomberg estimate at around 5.1% growth for this year. And that was cut from 5.2%, which gets us closer to Beijing's goal of about 5%.
Well, Sherry, I have a feeling we'll be talking with you tomorrow about what more incremental moves we see.
I know, right? What else can we see at this point?
Yeah, Sherry Ann, our Bloomberg Emerging Markets correspondent, thank you so much. Still ahead, a light at the end of the tunnel for Best Buy as the electronics retailer sees signs of a sales slump bottoming out. We'll get into it next. This is Bloomberg.
Names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Time now for top calls. Look at some of the big movers on the back of analyst recommendations. And we start with energy drink maker Celsius. Piper Sandler boosting its price target to a street high of $215. That's up from $185, and the rating was kept as overweight. The analyst views the company's surprisingly high second quarter margins as sustainable. You can see shares higher by about 2.6%. Next up, 3M upgraded to peer perform over at Wolf Research following its $5.5 billion settlement over claims that it sold defective combat earplugs to the U.S. military. While details of the deal remain, quote, sketchy, the firm says that the payout is about as good as could have been expected, shares higher by about 1.8%. And finally, we have Verizon raised to buy from neutral as Citi takes a more positive view on telecommunication stocks. The firm says that wireless is showing positive signs of stabilization, and better free cash flow should help reduce its net debt leverage. Shares currently higher by about 3%. And those are some of our top calls. Meanwhile, Best Buy now saying that they've reached the, quote, low point in tech demand after a strong second quarter report pointed to improvements in appetite for consumer electronics and appliances. Sean Dunlop is an equity analyst over at Morningstar. He joins us now from Chicago with a buy rating, on shares of Best Buy. And Sean, it seemed like a solid report overall, but what do you make of management's decision to lower its full year sales estimate?
Yeah, it's interesting. Obviously, that's been punished elsewhere as you look at Dollar Tree earnings. It's a very challenging environment for consumers. It's an extremely price elastic category. Consumers are reining in spending on the goods side. We see that. We saw that with Dollar Tree. We saw that with Family Dollar. Obviously, profitability was a bright spot. I think that's what the market's reacting to. But as we plan to lower our $100 fair value estimate by a mid-single-digit percentage, we harbor a couple of longer-term concerns for the retailer. We don't see any real ability to drive an inflection in sales growth in this industry, particularly as sales continue to migrate online. And then one of the callouts that gave us a little bit of concern was the nod to normalizing credit card charge-offs. So for Best Buy, we estimate that that's about 25% of tender and as much as 20% of operating profit. So if we were to see that tick up even incrementally in 2024, that could be a pretty meaningful headwind.
Speak more to that particular data point. How much worse can those charge-offs get? And is that a ripple effect we might see beyond Best Buy?
Yeah, I think that's a reasonable conclusion to draw. There are a number of retailers for which these co-branded credit cards are a meaningful portion of operating profit. You look at Macy's, you look at Kohl's, Best Buy obviously has a pretty large program. And the problem is that we continue to see sort of higher than normal levels of profitability, lower than normal levels of provisioning and charge-offs continuing in the space. That the U.S. consumer continues to remain healthy, but a lot of the leading indicators are starting to point in the wrong direction. Consumers are assuming a little bit more debt. We're starting to see sort of a larger balance of rotating credit. And in the long run, if we were to see that continue to deteriorate, that could eat up a pretty large portion, as much as 1% of Best Buy's operating income.
What about the idea that they put forward that things are getting better? What is the upside risk that they present here? And the idea that maybe they make it out of the woods here in terms of, this being the worst it could get when it comes to some of the softer data they're seeing?
Yeah, they just might. It's a good point. So there are a couple of positive signs here. Obviously, the industry is sort of the tide that raises all ships. And we are at a point where after a demand pull forward in 2021, we're starting to see sort of sales flatten and hopefully inflect next year. It depends a little bit on how consumers are feeling moving into 2024. Part of the problem is we're still in this weird phase where consumers are not yet running into replacement cycles from the phones and the laptops and the entertainment devices that they purchased in 2021. Hopefully we get to that point, and that would certainly provide a meaningful benefit to Best Buy. You think about, if you purchased a phone in 2021, you may not replace it until 24 or 25, and we're running into similar effects with entertainment and with home office setups. Also, what we're starting to see is as the firm has rolled out a 3-tier loyalty program, you're seeing a little bit less cannibalization of what are really profitable services. You think about installations, you think about warranty touch points. And to that effect, a bright spot was we saw services revenue tick up almost 8% in the quarter, and that's really high margin revenue. So the combination of those factors could potentially provide a little bit of near-term upside for the name.
And Sean, looking out long term, it feels like shopping increasingly has moved online. You have the likes of Amazon being the first choice for a lot of consumers. Then you think about a firm like Best Buy, which has a lot of physical locations. It has a lot of brick and mortar presence. How does it shift some of those customers online? How does it deal with the Amazons of the world?
Yeah, it's a great question. Best Buy obviously under indexes to online sales. They do about a third of their sales through online properties. Industry-wide, that figure's about 55 or 60% of consumer electronics sales come through online channels. So there are a couple of levers there. Obviously, they called out the development of the mobile app. About 20% of their digital sales are coming through that channel now, and that's fairly incremental. They've obviously tried to push consumers in that direction with the loyalty program, with Best Buy Total Tech, with Best Buy Plus, and that's been met with some degree of success. If you think back to pre-pandemic, the firm was only doing about 19 or 20% of sales through that channel. But obviously they under-index there. And the other point to call out is that channel is typically, it carries a lower profit margin for Best Buy than would an in-store sales. So they find themselves in between a rock and a hard place in some ways here. And even as they work to take costs out of the P&L, as you think about automating certain chatbot functions with AI tech, as you think about sort of getting employees to float across multiple departments. In many ways, Best Buy is really running in place, and we think that they'd be lucky to get back to that 4.5% or 5% gap margin figure moving forward.
Yeah, a lot of considerations there to keep an eye on. Best Buy shares currently up about 5% at the moment, though. Sean, really appreciate your insight today. That is Sean Dunlop over at Morningstar. Now, coming up, we'll be joined by Bindia Vakil. She is Resilink Chairman, CEO, and co-founder, stopping by to discuss how natural disasters are impacting global commerce, shipping, and supply chains. That conversation up next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
for our Wall Street Week daily segment. David Weston, the host of Wall Street Week, joining us now.
Thank you so much, Katie. So we thought we were getting past some of the supply chain problems, right? Well, we're all seeing those images now of the Panama Canal zone as the levels go down in the water and the ships build up outside the canal trying to get through. So it raises questions about what is going on with the supply chain. And for an answer, we turn now to Vidya Vakil. She's Resolink Chairman, CEO, and co-founder. Vidya, thank you so much for being with us. Your work at Resolink is focused on monitoring risks to supply chain, specifically with respect to the Panama Canal. How big a risk is that?
You know, it's not on the scale of the LA Long Beach port disruption that we saw. It's also not on the scale of the Shanghai port disruption. There are few silver linings here in this particular case. We have more inventory levels onshore regionally going into 2023 than we had in 2019 going into the pandemic and those other events. We also have more emphasis on companies regionalizing their supply chains. So I think there's a silver lining here. Having said that, definitely companies are going to be seeing shipments, their transportation cost increase by 30 to 50%, just depends on the route, as well as delays of, if not a few days, then several weeks on certain ships, especially those that have, which do not meet the weight limits for transportation seamlessly through the canal.
And Vidya, that's about the Panama Canal. We also hear reports out of the Rhine. Obviously, that's been having some problems for a while now. I've seen reports about the Yangtze River and even the Mississippi River. So how widespread are these challenges with navigation with respect to the supply chain?
David, globally, extreme weather events have been tripling since 2019. We saw about, in 2016 or 17, Resolink would have reported maybe 70 to 80 extreme weather events a year. Last year, we saw that go over 350, so it's been multifold increase. We see 6 times the number of flood-related events, and now we're talking about drought. As you said, Rhine, Yangtze River, we saw Mississippi, so all of the waterways and ocean choke points, such as Suez Canal, Strait of Hormuz, the Panama Canal, are all choke points, right, that are impacted by climate change and these disruptions. A bigger issue is actually on the factories as well. When you have these droughts, they affect the company's ability to get uninterrupted water and power, both of which are essential. In certain industries, factories cannot have any interruption to availability of water and power. We also see one more issue, which is that globally, when you look at the business continuity plans of many factories, they do not have backup power available. And certainly if they have backup power, it powers up lights and climate, but not the actual line itself. So availability of water, power, these are all critical risks that are facing the supply chain.
Vidya, you mentioned some of the factory issues. We're seeing a lot of investment right now, spurred by the U.S. government under the CHIPS and Science Act for the so-called semiconductor fabs. I see some of those are being built in places like Arizona. Is this a possible risk to that plan?
Absolutely. It does require additional investment worth multiple hundreds of millions in order to recycle the water. A wafer fab requires 9 million gallons of clean water a day. And so that is not a small task for a drought zone. In fact, in Taiwan, we've seen drought cause supply chain and semiconductor disruptions because, semiconductor factories, as I said, require uninterrupted water and power. So these companies that set up fabs in these regions need to make those additional investments in backup power and recycling water continuously. This is also why companies need to map their supply chains. Unfortunately, many companies don't really realize that their site in Arizona actually has a supply chain that spans across the world and might require 15 to 20 weeks to replenish inventory. So mapping the supply chain and monitoring for these disruptions, really knowing where the factory is and whether it's in a high water region or a low water region really affects the type of mitigation plans that our customers are working on this with many suppliers as we speak.
Vidya, going back to the aftermath of the pandemic, you and I talked at the time about things like friendshoring and reshoring, really redoing supply chains in light of what we'd learned from that. Is that going on? You're monitoring that now. Have those supply chains been refactored?
it takes many years, but this is a passionate issue for me personally. We see companies are looking at Central America as well as south of Mexico. These are very competitive cost-wise, as well as availability of labor and natural resources-wise for companies to locally source, bypassing oceans entirely and having a land-based supply chain by working closely with our partners here. Actually, in Europe, we see a similar regionalization happening with countries in Africa where there is access to clean water, power, and plenty of labor, actually at highly competitive rates.
Medea, it's always so good to talk to you about supply chains. That's Medea Vakil, Resolink Chairman, CEO, and co-founder. Tomorrow, we're going to be joined by Dr. Linda Maxwell, DCVC operating partner, a big investor in big tech in the healthcare industry. And Friday, we'll talk with Larry Summers, former U.S. Treasury Secretary, taking us through the jobs numbers that will be coming out that day. That will be at 6 p.m. Eastern Time on Friday on Wall Street Week. Katie?
Well, still ahead on the close. We're going to have much more on the markets, and we're looking at a big, broad rally here, once again, across asset classes. You can see two-year Treasury yields down by more than 15 basis points after that jobs data that we got this morning. That extends throughout the curve. You take a look at the S&P 500 right now. The stock market pretty close to session highs. The S&P 500 currently up by 1.3%. It's looking at its second day of gains, first back-to-back day of gains that we've seen in August, which tells you just how ugly this month has been up to this point. Then you take a look at the NASDAQ 100 also getting in on those gains. Big tech outperforming of about 10%. From New York, this is Bloomberg.
is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Very good afternoon, everyone. Welcome to Bloomberg Business Week, live in our Bloomberg Interactive Broker studio. We are streaming on YouTube and, of course, on our streaming service, Bloomberg Originals. It is just Tuesday, Lemon.
It's just Tuesday. But you know what, Carol?
What?
It's a holiday weekend.
Woohoo!
Okay.
Yeah.
U.S. Open's coming up later this week. Well, it's on now.
I was out in the subways, man. There were people just pouring to the Open. You could see them, like
Love
in their
it.
gear.
We're going to be
Just going out.
broadcasting from there on Thursday and Friday. Do not miss it.
I look forward to it. It's going to be a
I
lot
do
of
too.
fun. And crisscross our fingers that the weather's nice.
I've just checked.
It's good.
It's looking good for now.
Hey, speaking
Lots
of
of
looking
sunshine.
good, if you're a bull in this environment, this is your day. Thank you. You're welcome. The risk trade is definitely on. It's a broad-based stock rally. U.S. Treasury yields backing off following some softer U.S. economic data. We are all over the data. We're all over the trade today.
Also, we're all over equities that are making big moves. Best Buy rising the most, Carol, in 9 months. That following earnings. Yes, it's still earnings season.
What's all those big TVs you were buying over the last
Washers and dryers. I did just buy a dryer.
Did you?
Yeah, it hasn't been a great experience. Not at Best Buy. Maybe I should have bought it at Best Buy.
Maybe you should have. Hey, we're also going to talk about the crypto sector getting a boost, too, as a U.S. court paves the way for a spot Bitcoin ETF. Feels like a turning point.
But why is it necessary? We're going
I
to
don't
dive
know.
into that a little later.
Why is it necessary?
That's the question that I'm going to be asking our guest a little later in the program.
Hey, and if you're wondering whether EVs are passing maybe a crucial tipping point, go nowhere, because we have the answer to that. And we'll talk about the tech adoption curve that is happening right now. And then also happening right now, Jamie Dimon, among a group of A-list CEOs, saying, President Biden, we need your help.
Yeah, we'll tell you what he's asking for help with and what that group is asking for help with. Also, Carol, how New York's weed stores are exposing banks to illegal drug sales. Did you see that coming?
No.
No, neither did I.
I mean, come on. It's like we've all been talking about this. We're going to get into that. And we're also going to go inside the Hollywood scene and the writer's room with TV writer and producer Patty Lynn. You'll know the programs that she has worked on, but we're also going to get into why, after retiring at the ripe age of 38, why she couldn't talk about her career because the memories were too painful. You think it's going to be one kind of story, and then right off the bat, she really sets the tone.
Yeah, she has credits that include Freaks and Geeks, Friends, Desperate Housewives, Breaking Bad, and more.
Yeah, I mean, it's really interesting. I think we all think it's all fun and games. You're talking with celebrities and actors and actresses, but man, when you start to peel back the layers of any industry, you really get some realities. And so she's going to do that for us. Right now, though, it's time to peel back the layers on today's market. The risk trade is on. Time for Countdown to the Close, starting now.
To the close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Katie Greifeld and Shonali Bassick. We're joined now by our colleagues Carol Masser and Tim Stenivek. We together welcome in full all of our Bloomberg audiences, TV, radio, YouTube, originals, you name it. And Carol, I don't want to jinx it, but we're looking at the first back-to-back gains in August.
Yeah, you have all these bulls like looking over your shoulder, so don't turn around now, Katie. I mean, yeah, it's definitely this broad-based rally, and it all has to do with the data dump that we got today. I mean, let's go through some of it. You had U.S. job openings falling in July, more than expected, to more than a two-year low, and so maybe that tight labor market is loosening up. And then you also had consumer confidence also falling, views on jobs, inflation worsening. And then, Tim, there's something very near and dear to you, because I feel like you've been watching the mortgage market in a big way.
Yeah, mortgage rates topping 7%. Dousing those hopes about U.S. housing market thoughts. We got a lot going on right now, Shonali, that's kind of coming to a head. I want to start with the job openings declining to 8.83 million, the lowest since early 2021. The question is, are we seeing a return to normalization, or is this something to be more concerned about? I tend to think we're seeing a return to normal, but the analysts didn't necessarily see this one coming. This came in way below estimates.
It's interesting to see it come in below estimates, and it's interesting to see some of the softer consumer data give some heat to the story of lower interest rates moving forward at some point potentially, and therefore that will save the market. That's why you're seeing exactly. And so as long as this data doesn't get too hard, to your point, it is well below expectations, but at the same time, a normalization would support lower rates, which has a positive effect for the consumer that is feeling those bites of delinquencies in credit cards, as well as higher mortgage rates, making the cost of housing very high.
A lot of cross currents to keep an eye on there. Of course, this all feels like an appetizer for Friday's jobs report. But before we get there, it feels like we've been talking about travel a lot on this simulcast in particular. I want to do more of that right now because there was a really interesting story on the terminal today about more Americans are planning vacations even as they sour on the economy. Some really interesting survey data out of the Conference Board. Nearly half of consumers in August are planning a trip in the next 6 months. That is the highest share all year, and about 1 in 5 of them are going abroad. That is a record share in the data that goes back to the 1970s.
Well, and what's interesting is, okay, right, we all want experiences. We're still seeing this trend coming after the pandemic. The thing is, how long does this ultimately last? Just speaking to what you were talking about, Shanali, earlier, we're looking at concerns about rises in credit cards or defaults. How much more spending can the consumer do? I mean, at this point, it looks pretty hot, but you do wonder, when does this all come to an end or at least slow down substantially?
I wonder what counts as a vacation, because we have a couple, bar mitzvahs and weddings that we have to fly.
Not a vacation.
Sorry, that I get to fly to later this year. Is that considered a vacation?
I think it's when you work from home for 2 days at the end of the week.
It's no
I have
dogs,
a friend,
no kids.
That was a dig at me.
I think it's a good point, Carol. I have a friend who says, going on vacation with kids is just watching your kids somewhere else. So
I was saying
don't
to
know.
somebody at work the other day that it's been so much time with my family that work is my vacation from my family. I do love my family, but my goodness, hasn't been a lot of time together lately.
I do think the conversation about what is a vacation is really interesting, and the workcation, it kind of became a thing in the last 3 years. Now with all these return to office policies, maybe we see what is a vacation start to normalize.
All right, well, no vacation for any of us because we're going to be back in less than an hour's time. We're going to count you down to the close on this Tuesday. Got a little bit of earnings, too, after the closing bell from HPE and HPQ. But join us on radio, TV, YouTube, and, of course, Bloomberg Originals Beyond the Bell at 4 p.m. Wall Street. Data showing that maybe, that lag effect starting to have an effect in terms of its impact on consumer sentiment, maybe not as many job openings, so people aren't moving around as much. And then we have mortgage rates that, are really making people take a pause when it comes to buying homes.
It all raises the question, Carol, what's the Fed going to do in September and after?
Fed's going to do what it's going to do, Tim.
Because the Fed is in control.
The Fed is in control. Let's get into it, though. We've got a great lineup to talk equities and rates. Ira Jersey is Chief U.S. Interest Rate Strategist over at Bloomberg Intelligence. He is on Zoom from RBI headquarters in Princeton, New Jersey. Hi, Ira. And
hey, Carol.
We have Jess Metton, Deputy Team Leader for U.S. Equities here at Bloomberg News. She's here in our Bloomberg Interactive Brokers studio. I do want to start with you, Ira, because the reason we have a rally is because we see rates backing off. Talk to us, because if I pull up my charts, they look like some pretty big moves or significant moves along the U.S. Treasury curve, but you're the expert.
Yeah. So the risk on in the equity market probably is because it doesn't look like, with some of the data that came out today, that the rate market thinks that the Fed's going to hike either in September or November. Like, basically, they're saying that the Fed's done for now, and that's one reason why you've seen what we call a bull steepening of the yield curve. So where you have the front end of the Treasury market doing better than the longer end of the Treasury market. So 2-year yields down 16 basis points today. I do have to question, Carol, is how real some of these moves are, because we are in the last week of August. Liquidity is not particularly good. I was looking at some of the depth of the market data that we have here on the Bloomberg terminal, and it didn't look like we were particularly liquid today. So I think some of these moves we have to take a little bit with a grain of salt. But certainly, the data wasn't good today, and I think that people are setting themselves up for into September being a little bit long the Treasury market at higher yields than you could get a month ago.
Ira, I'm just going to let you know we're dancing like Elaine from Seinfeld in the studio. Having said that, I don't know why it's just a wacky Tuesday. What about that 7-year auction, though?
Yeah, the 7-year auction was actually really good. It was actually the best 7-year auction that we've had since January, which was kind of surprising because oftentimes what you get at Treasury auctions is when the market rallies as strongly as it did with 7-year yields down by 10 basis points, people say, well, I'd rather have a little bit of a higher yield, and they kind of stay away from those auctions. But that wasn't the case today at all. In fact, we had a bid to cover that was basically as high as it was the last couple of auctions, and importantly, this was a bigger auction, right? The Treasury Department is issuing more bonds, and even though they're issuing more bonds, there was demand there to sop them up pretty aggressively.
Okay, so let's bring in Jess Menton, who is deputy team leader for U.S. equities here at Bloomberg News. You heard Ira say don't read too much. One big takeaway that I have from you, Ira, and forgive me because I'm just, using the Cliffs Notes versions here, is that don't read into this too much because of where we are when it comes to the season and what things look like next month and what traders are positioning themselves to do. My question for you, Jess, is do we trust the equity rally that we see today?
So obviously, like we've been talking about, part of this is due to what we've been seeing with yields coming down here when you're looking at the 10-year particularly, but also I have to point out 3 other things that I'm watching today that has to do with this rally. So the S&P 500 broke back above its 50-day moving average. That's been a key threshold. So can the S&P 500 close above 44.61? That's very major there. Also,
that's the 50-day?
Yes.
Okay.
That's around that level. And then also, I have to point out, NVIDIA actually recaptured 472. That was actually where it closed right under that last Wednesday and Thursday. And then obviously we saw a bit of that rally there. But then it coming up now it's the 3rd biggest weighting in the S&P 500. That had been Amazon. So now it's right around 3.2%, just slightly more than Amazon. And then a third thing I have to point out is the dollar. So if you look at the DXY spot index, this is something that I had been talking to Tim and Carol about in recent weeks. So if you look and you pull up a chart and look specifically also at the RSI on that from mid-July to now it's at right where that overbought territory is. And it started to come down on Friday once Fed Chair Jerome Powell started speaking. So you also have that dollar index coming down a little bit. It's around that 103 level, which has been really crucial because it crossed above that earlier this month. And so can it continue to come back down?
It sounds
interesting.
So it feels like, and I'm just kind of building, I think, on what you said, Ira, that a lot of it feels just like a technical move to some extent.
Well, I don't. It may be a little bit technical.
Okay.
Certainly, similar to equities, the rate market did get a little bit oversold, particularly in the belly of the curve, so that 5 and 7 year sector. So some of this is technical, and we did also reach, or pretty close to the yield highs. And some people would say, oh, well, we broke it by 1 basis point, but to me that's noise. And when we do a lot of look at charts and do technical analysis, I'd say that we just did a second test of the yield high up around 4.35% on 10-year yields. So if we can remain below that, then obviously that's technically supportive for the Treasury market, and you can see maybe rates rally a little bit more from here. It's so hard at this time of year to really want to step in and get uber long or uber short the market. If you've had a good year, you probably want to lock in some gains, and I think that's some things that maybe are going on a little bit where people who were short going into June and July and early August after the Fed meeting in late July, you've done pretty well. So why not take some chips off the table? And obviously, you also want to probably square your shorts because we get PCE on Thursday, we have payrolls on Friday. With liquidity the way it is, do you really want to get whipsawed in this market? So I think people are going to stay pretty close to home until after we see some of those numbers.
I mean, silly me, Jess. I thought today's move, both in the rate market and in the equity market, was all due to that JOLTS number, because it shows that high interest rates are finally having an effect, and there could be, the long and variable lag has taken effect.
Well, it's interesting because if you do pull up WIRP, what Ira was basically signaling earlier when he was talking about yesterday versus today, you can see a difference there, especially as far as what those look like when you are thinking about the Fed obviously being done. And Anna Wong over at Bloomberg Economics, she actually was already calling for the Fed to be done hiking actually back in July. And so she feels like, but pointed out that some of the increases we've seen in some of the energy prices on a month-over-month basis might begin to start trickling in, say with the August data that comes out on the 13th, but not necessarily enough to force them to hike again. But she's been on the nose with a lot of calls, but that actually has been her call for the latest few months.
Yeah, we had a guest yesterday talking U.S.-China, Stefan Seelig, who worked on Wall Street, then was part of the Obama administration, undersecretary with trade, dealt with a lot of China issues, has dealt in M&A. He's got his own consulting firm now. And, you know, it's interesting. He actually talked about maybe another, I think it was 3 or 4 interest rate increases, because talking about structural changes. Ira, is it safe to say that we actually don't know what we don't know in terms of ultimately how the Fed's going to, you know, how it's going to play out?
Well, we don't know how it's going to play out primarily because of the uncertainty of forecasting, right? Like we don't know for sure if inflation is going to remain where it is or if it's going to reaccelerate. There's other reasons to think that some CPI data might actually reaccelerate because things like health insurance costs might actually start to turn up a little bit or at least stop going down, and that will have an effect as well. But I think from my standpoint, and you know, Anna and I have been broadly on the same page for most of this move, and you know, but even the entire cycle is at this point, it's not whether or not the Fed's going to hike again. If they hike one more time and stop, or they don't go again, that's not what's important to most of the Treasury market, right? Treasury returns are going to come when the Federal Reserve stops hiking, and then we start to think about when they're going to start cutting. I think the big risk here for some things, and when you talk about WIRP, the World Interest Rate Probability Calculator that we have, when you look at Fed funds futures, when you look at overnight index swaps for where the Fed's going to be next year, I think one of the things that is a little bit mispriced is these cuts in May and June of next year that are being priced in. And I think that the Federal Reserve might like to wait longer, right? So at this point, it's not how high anymore. It's how long do they remain at the peak before they start to cut. And then once they do, how aggressively will they cut? So it seems like the consensus, more or less, is that the Fed's going to start cutting gradually next year. I suspect that they don't cut at all. And once they do, they wind up cutting much more aggressively.
Why do you think that, Ira, just in the last minute that we have?
Well, just because I think that the job market is going to remain robust enough that the Fed and inflation is going to remain kind of stubbornly at around 3%, where the Fed's not going to feel like they have to cut early. And then once it becomes obvious that there is a significant slowdown in the economy and we start to see some serious job losses, that's when they wind up cutting interest rates, you know, not in 25 basis point increments, but a couple of times at 50 basis point increments. So I think that that's the interesting mispricing that's going on kind of in some of the forward markets.
And that's potentially when the tide goes out for companies and whether or not there's some exposure there. I mean, what's good is a lot of companies, right, refinance debt at very low rates, and that'll keep them pure, I guess, or paying low rates for a while, Jess.
And then also typically,
and making money on any of that money that they put in the bank.
Right, and usually cuts historically don't really bode well for the stock market because they're worried about the trajectory of the economy.
Right, but if we're working, potentially, I don't know. It's an interesting environment, no doubt about it. Thank you, guys. Really great setup for us. Ari Jersey, of course, Chief U.S. Interest Rate Strategist here at Bloomberg Intelligence on Zoom from our BI headquarters out there in Princeton, New Jersey. Jess Metton in our Bloomberg Interactive Broker Studio, Deputy Team Leader for U.S. Equities for Bloomberg News. She wears a few hats for us all here at Bloomberg. All right, you are listening and watching Bloomberg Business Week. Carol Massar along with Tim Stanovic. He's back. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ very much in the green. Right now we're at the best level of the day on the S&P 500 index. 38 minutes to go ahead of the closing bell. Stocks on track for their biggest advance since June. Bond yields, though, retreating after economic reports bolstered speculation. The Fed will be able to pause its rate hikes in September. Right now, the Dow up 248 points, up by 0.7%. S&P 500 index up 61, a gain of 1.4%. NASDAQ, the composite index, up 243 points, up by 1.8%. 10-year yield 4.11%. We've got the 2-year yielding 4.88%. Spot gold up $17 the ounce, up 0.9%. And West Texas Intermediate crude up 1.4%, 81.21 a barrel. So stocks on track for a higher close today, perhaps putting it mildly. Bitcoin, though, a major story today, surging 7.4%. Bitcoin now at 27,913. An up day for the Dow, the S&P, and NASDAQ. As for that market backdrop, Gabriela Santos is global market strategist at J.P. Morgan Investment Management, and she spoke with our Tom Keene this morning on Bloomberg Surveillance.
One of the most important things we're having a conversation about is we might have this more constructive view about the economy, soft landing, and about earnings. We do think the earnings recession's behind us, but that doesn't translate neatly into buy large cap U.S. stocks. Just because they've gone up so much, and because a third of them is just the 10 largest companies that have valuations 145% of normal.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Recapping S&P up 1.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So Charlie's been keeping an eye on it. Our TV colleagues, we have too, and that is shares of Best Buy, Tim. They were up 6.5% at their highs. Right now, a little bit more than a 4% gain, but they did reach their highest level and moved the most in about 9 months today.
Yeah, this after executives said that a painful sales slump in consumer electronics and household appliances is showing signs of easing. Perhaps people are like me and need a new dryer and don't really have a choice. Well, the slowly improving performance signals a measure of relief from a sharp downturn that began more than a year ago, Carol. This was as U.S. consumers retreated from electronics and other discretionary goods. This is after we binged during the pandemic. You know, you can only buy so many of these things for your home.
I remember being somewhere and it was like, we need to replace a stove. It was actually on vacation, a vacation place, and it was like, sorry, you're just gonna have to live with the stove as it is because we can't get you a stove for at least another 8 months or something. So it was crazy. So let's get to it. Let's see what Lindsay Dutch has to say. She's retail and industrial REITs consumer hardlines analyst at Bloomberg Intelligence. She covers a lot. She joins us on Zoom from BI headquarters in Princeton, New Jersey. Lindsay, thanks for being with us. Walk us through what we got from Best Buy and what we know about their outlook.
Yeah, thanks for having me. So I think there were a couple positive signals coming out of Best Buy this morning. Sales declines are going to extend at least into the third quarter, but there is a possibility for us to see some growth in the fourth quarter. And that's, as you guys were just talking, there is some replacement demand that we see on the horizon, maybe in computing, possibly home theater. There's also bright spots in gaming with some new software releases. So we see a possibility for growth as early as the fourth quarter. And then next year looks a little bit better. I mean, this is coming off of pandemic-driven highs. You know, we had revenue declines of 10% last year, another about 4 to 5% this year.
But are those, those are tough comps, right?
Exactly. So the comparisons got really tough last year. Comparisons are starting to get a little bit easier in the back half of this year. But there's still pressure on the consumer. Electronics is one of the weakest demand categories. Home furnishings as well. And if we think about big ticket especially. So for Best Buy, it's sort of a double whammy. It's the electronics piece, it's the big ticket piece. So we're still seeing some pressure on the consumer there, seeing elevated discounts really to drive store traffic.
All right, so that explains too why we're seeing Best Buy down about 4% so far this year. I feel like it speaks to, Lindsay, something we talked earlier with our TV colleagues about. get ready for people to, like, they're all eager to travel again or continue to travel. Like, we are continuing to see that mode of just wanting to go out and experience things. We're still feeling that after the pandemic. And I do feel like when it comes to how consumers spend, it's still, we're working through our way to a reset on all things because there's still a bit of a pandemic impact.
Exactly. We are still seeing that impact. I think also another key driver as we look forward and think about growth coming off, this trough this year is, new innovative technology. And a lot of that innovation really took a big pause during the pandemic. And I think, as we've come out of it, there's more of that happening and we might be able to see new product coming in when we think about next year, and that could really drive sales as we think going forward.
Hey, Lindsay, very briefly, does it tell any story about the strength of the consumer? Can we read into it like we'd read into a Walmart or a Target?
I think it's a little bit difficult to give a broad read. I mean, I think people are still spending. They did see a little bit better of a back to school season than they were expecting. I think there are definitely positive signals going into the fourth quarter, but it's still very clear that the consumer is value focused and promotions and discounting is going to be a key driver of traffic and sales in that fourth quarter and holiday selling season.
That's fascinating to hear, right? Back to promotions. All right, Lindsay Dutch, thank you. Retail and Industrial Consumer Hardlines analyst over at Bloomberg Intelligence there from our BI headquarters in Princeton, New Jersey. Should we talk about crypto?
Yeah, I'm taking a look at Bitcoin right now, and I haven't seen a rally like this in quite some time. It's up 7.4% just today, Carol.
Yeah, I'm looking at the whole crypto monitor on the Bloomberg. Like, it's all up. Ethereum's up about 5.5%.
Which makes no sense. If this is about Bitcoin, then why is every other crypto higher?
I'm sorry, Tim Stanovic, you want sense when it comes to the crypto market?
Maybe Hannah Miller can help us make sense.
I hope so, because we did have a 3-judge appeals panel in Washington today overturning a decision by the SEC to block a spot-based Bitcoin ETF from Grayscale.
Does that make sense to you?
I always feel like I need an interpreter when it comes to all things crypto. We do get an assist, though, from Hannah Miller. She's digital currencies and venture capital reporter for Bloomberg News, and she's with us on the phone in San Francisco. Hannah, take it away. So, big decision, significant, help.
Yeah, so this is a significant decision for the industry. This has been a very drawn-out battle. This has lasted years, and it is paving the way for the approval of the spot Bitcoin ETF in the U.S. But that is not definitive. There's still a lot of stuff that needs to happen. There still needs to be an approval process from the SEC. So I've been talking to people in the industry. It's been a lot of cautious optimism about what's happening here.
Okay, forgive the question, Hannah. But why do we need a spot Bitcoin ETF when Bitcoin is so easy to buy?
Oh my God, they're banging at the doors, Tim, the crypto folks.
No, that is a great question. So this spot Bitcoin ETF allows people to have exposure to Bitcoin without actually buying the cryptocurrency. So for people who are, a little nervous about Bitcoin, especially amid all of the regulatory uncertainty happening here, this is a way to kind of get a taste of the action without, going all in. So a lot of people think that this could broaden mainstream adoption among both retail and institutional investors.
So what do you own then?
You have an ETF that's tied to the spot Bitcoin price. You are able to track the market, and they're hoping that the discount between the Grayscale Bitcoin Trust and Bitcoin itself will narrow. With this decision. And we've seen that happen. These two are becoming more closely aligned in price. So, GBTC is up, Bitcoin is up. The industry is celebrating right now.
Sounds like a derivative. I don't want to get too mechanical here because I know we're talking crypto and not necessarily ETFs. This is not ETF IQ, but it's just, again, I question the need for something like this and also the reaction from the entire crypto market.
Yeah, I think the entire crypto market is just looking for some positive news here. I mean, there's been, such entanglement with regulators. There's all these legal battles. This is, a much needed win, even though, there's still a lot of uncertainty about what's going to happen here.
So is there a timeline, a date that's kind of on your radar as to what's next?
Yeah, so we could see an approval as soon as next week. There's this Labor Day deadline. And, that could happen, but again, there are a lot of logistics that need to, play out here. The SEC has to decide how they're going to react to this, if they're going to, file with new reasoning for their rejection, or if they're just going to capitulate here. So there's stuff that we still need to watch.
It always feels
like a lot of buzz about,
No, go ahead, Hannah.
Oh, there's just also a lot of buzz about Ethereum products, Ethereum ETFs, whether this could help pave the way for those.
I always just feel like whenever there's like a crypto story, Hannah, I don't know, Tim, like it's like, hey, good, but like there's always a lot of buzz.
Well, that's so my but question for Hannah before we go, just in the last minute that we have, does this mean that Chair Gensler is a friend of crypto now?
I wouldn't go that far. I think he's taken a couple of blows here. This is the latest setback. We'll see what happens. But yeah, I think it hasn't been the easiest road as of late for Gensler and the SEC.
All right, well, it's keeping us on our toes in these dog days of August. That's going to say, that's for sure. Hannah Miller, thank you. She's digital currencies and VC reporter for Bloomberg News, joining us on the phone from San Francisco. You did so much reporting, too, for Crypto IRL.
Yeah.
And so how are you thinking about these
this is something that the industry has wanted to see for a very long time, so it's a huge win for the industry, but I still question is it a product that
I want to see
actually
unicorns
has a huge
flying in the
use?
sky, but does that mean it's a good thing?
Again, it's so easy to buy crypto. You can use PayPal or just pull out your phone and buy it.
But does general investors feel like it's so easy?
I think so.
All right.
Yeah, it's really easy.
I don't know. All right. It's to be continued, that's for sure. Right now, though, we've got to get a check on world and national news. Off to Leslie Lotto we go. She's in our Bloomberg 1130 newsroom. Hi, Leslie.
Thanks, Carolyn. Tim, Hurricane Idalia now forecast to become an extremely dangerous Cat 3 storm, predicted to slam into the Big Bend area of North Florida sometime early tomorrow. There will be life-threatening storm surges and widespread power outages. Florida Governor Ron DeSantis here.
Assume you're going to lose power if you're in the path of this storm. That's likely to happen, and so just prepare for that. Expect that.
FEMA Administrator Deanne Criswell said personnel and resources are being deployed to Florida, Georgia, and South Carolina. She warned residents to take the storm seriously as she expects Idalia to strengthen to a major hurricane by the time it makes landfall. She says high winds are expected and the storm could bring up to a 12-foot storm surge in some areas along the western coast of Florida.
The president quickly approved an emergency declaration in advance of the storm in Florida, turning on the many tools that are available at my disposal to provide the governor any support or resources he may need.
The University of North Carolina grad students charged with first-degree murder after a fatal shooting on campus yesterday. One faculty member shot and killed in the incident that triggered a 3-hour lockdown of the university's campus. As we reported, classes at the university are canceled for today, too. And Tesla has to make some changes as it faces increased scrutiny from federal regulators over its driver assistance system known as Autopilot. Electric car maker now the target of a special order due to concerns about a possible workaround of monitoring that is meant to keep drivers' hands on the wheels. The U.S. National Traffic Safety Administration posted a letter on the website about it. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got 20 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ, all advancing. We are trading very close to session highs right now. Let's head over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks with a strong bid today after the weaker than expected 10 o'clock economic data. Dow is currently up 272 points. S&Ps are up 63. That's having its best day since June. And NASDAQ is higher by 242 points. The U.S. 10-year yield drops to 4.11%. Gold is down 17. Oil is in the green. And Bitcoin soared 8% as the U.S. court paved the way for the first Bitcoin ETF. Among the main 11 S&P sectors, all were trading in the green, led by gains in telecom, consumer discretionary, and tech. And leaders to the upside in the Dow, Verizon, Apple, and Intel, J&J, and Chevron led to the downside. After earnings, Best Buy beat estimate. Shares are up 4%. And in other news, Catalent reached a deal with Elliott and added new seats to the board. Wrapping things up, some of the names pointing after the bell tonight include HP Inc., Hewlett-Packard Enterprise, and PVH. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, into here live. Breaking news over your Bloomberg. Type Squawk SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. Just under 18 minutes left in today's trading
time flies,
session.
Carol.
It does indeed. It's funny how that works. You know, the clock just keeps going tick, 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 tick. And this is one for the bulls, everybody, because we're holding on to the gains. You just heard from Charlie. We're pretty much at our best levels of the session. You got 1.5% higher on the S&P 500, Tim, and 1.8% higher on the NASDAQ. And then you've got yields down on that softer economic news. So right now, traders are maybe, we talked about this at the top, maybe, the Fed is getting closer to being done. But yeah, I know.
Maybe.
Until we have another point of view.
You've been playing that game for quite a bit of time. Let's see what Nicole Webb, Senior Vice President at the Financial Advisor, at the Registered Investment Advisor, Wealth Enhancement, joining us on Zoom from Plymouth, Minnesota, has to say. Nicole, good to have you with us. How are you?
Hey, I'm doing well today. Thank you.
So does a rally like this have legs? Is it warranted?
I think today has a lot to do with the JOLTS data. Everyone's going to sing the same song there.
I'm glad you said that because I thought it had to do with the JOLTS data too. Finally. You can stay.
I think it's one of those weeks where bad news is good news. We're going to read into this to say, okay, do we have to price in an additional 25 basis points? And only 2 weeks ago, we were looking at shipping costs. We were looking at oil over the last 2 months, and we were going, okay, are we going to have some resurgence of inflation? Are we going to be talking about that, about just kind of additional stickiness in the back half of this year? And so some of the deterioration in jobs is meaningful. And I think you couple that with this pressure on return to work, which is showing a little bit of a nuance from a business perspective of we're not as fearful to lose you as we once were. So if it's a deal breaker for you to come to the office, that's okay with us. There's available workers out there that we'll go grab.
So when you and your team advise and are helping clients, and I understand it's long-term accumulation, everybody has specific investment goals, but what is it that right now in this broader market environment that makes you pull a trigger on something or saying, hey, we know you're in it for the long term, but you might want to think about this, or you might want to think about this. And what would those thises or that's be, if you will?
Yeah, I actually really appreciate you framing the question that way because all too often, we spend a lot of time talking about the risk on, risk off narrative, but that doesn't work the same way for a bank as it does for an individual. When we think about the market today, there's certainly opportunity below the surface. And so if we know or expect, or we think we know that we're in a higher for longer environment, and we know that this year had a lot to do with margin expansion. We know last week NVIDIA was a bit of a look through into what we could expect from the technology sector. You know, if we think about Jolt's data telling us a piece of the duration story, then in a moment like the one we're in right now, there's two things we talk a lot about when it comes to equities, and that's, you know, the 490 other companies we haven't been talking about this year, areas of growth like liquid natural gas, or companies with multiple business lines that aren't leveraged in this environment at all. And then you couple that with the story around opportunities in fixed income outside of just ultra short duration, meaning money market and T-bills, and look at when do we start to incrementally increase that duration exposure? Because rates at the levels they're at today are higher than we would expect the growth rate over the next 10 years to be. And that's when one starts to think about placing some of that extended duration in risk-free assets. So,
well, you know, it's funny that you say that. So is it the net there? And I've heard, you know, various folks around the table here in this in this studio say that, you know, you look at what's going on in U.S. Treasury yields, and you're right, like that's not so bad. And considering, you know, the reduced risk in going into a U.S. Treasury that's giving you 4 or 5% at this point, versus the risks potentially in the equity markets. Is that basically the net there?
Yeah, I also think one has to remember that, you know, volatility in the market is actually extremely profitable for the individual, for the long-term investor. The reinvestment of dividends alone in aggregate makes up a great sum of that total return perspective. And so when we think about the market we're in, you know, there's a couple of trends we think about for the year ahead. We do believe the stickiness of inflation, and that's been a huge win for large cap companies and their ability to pass along pricing to the consumer and not have volume decrease. We expect that trend to continue, but we also believe that we can incrementally be buying into the small cap spectrum, knowing that we've likely, you know, reached a price point where the price to entry is very inexpensive comparative to the large cap. And so I think you're going to see a lot of positioning or repositioning in the back half of this year when we come out of, you know, lame August. And it's all going to play into the story you're talking about.
You guys still have an expectation, a year-end target of 4,600 on the S&P 500. Here we are close to 4,500 at this point. What does the path between now and December 31st look like?
Yeah, we expect that there is, you know, last week was a bit of a game changer in terms of, you know, expectations around what NVIDIA would provide in terms of a look through into the tech sector. You couple that with, you know, some of the data supporting now that perhaps there isn't another 25 basis point increase yet this year. But at the same time, we do expect there to be a bit of a churning at the surface. This is where we step away a bit from passive investing and think more about being really thoughtful in how we deploy into specific names in the back half. So our expectation of how we get to 4,600 is less in that the top 10 of the cap weighting of the S&P and more of a churn below the surface that is less noticeable. And so all of that to say, a bit of a tighter trading range to get there, probably bouts of volatility in some of the tech sector as you seek that true up into the end of the year.
All right. Good to get some time with you, Nicole. Thank you. Nicole Webb, she's Senior VP and Financial Advisor at the Registered Investment Advisor Wealth Enhancement, joining us on Zoom from Plymouth, Minnesota.
Told you. Bad news is good news.
I'm with you because I think as soon as those data points came out, and it was one after another,
it was like,
right?
Vroom, vroom, vroom.
Exactly. And it's just like, well, wait a minute. Maybe the Fed is getting closer to being done.
Maybe.
Like
Ira said, wait till later this week. We're going to get a lot more data.
PCE.
And jobs.
And jobs. Those are big ones. And then there's still more to come until we get to that September 20th FOMC meeting.
Jay Powell's just like relaxing, enjoying some time in Jackson Hole.
Yeah, I went to the spa at Jackson Hole and I got some time, kids.
A little massage. Relax, take a load off.
Well, mani-pedi?
Yeah.
Maybe not. This is Bloomberg.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Grayscale Investments has won a key legal fight in its push to launch a Bitcoin exchange-traded fund, bringing the crypto industry to the precipice of tapping billions of dollars from everyday investors. The firm's court victory over the SEC in a 3-judge appeals panel in Washington represents a watershed moment for the largest cryptocurrency. Bitcoin is surging today, up 7.4%, 27,865 right now on Bitcoin. Grayscale Bitcoin Trust up 17%. We've got Coinbase, the largest American crypto exchange, up 15%. Marathon Digital up 28%. And MicroStrategy, the enterprise software maker that is the largest publicly traded holder of Bitcoin, up by about 11%. Home prices in the U.S. climbed for a 5th month as buyers competed for deals in the least affordable market in decades. John Lovallo is a home builder analyst with UBS.
We're still bullish. I think that it's an incredibly interesting dynamic that's playing out right now where there is just very, very little existing home inventory, 3.2 months to be exact. That's about half of what it should be. And so you couple that with the fact that demand out there is still resilient, regardless of the fact that rates are at 7.5%, and the demand is all being funneled towards these public home builders.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Those are our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
Yes, indeed. This is Business Week on this Tuesday. Carol Massar along with Tim Stenivek here at Bloomberg headquarters in New York City. We're going to head over to our TV colleagues in just a moment, wrap up the trading day, and it definitely is a risk-on, bullish trade, if you will. I mean, I had a plethora, a wealth of names to pick among for my gainers. Poor Tim's over here. It's like...
I'm like, find me a stock that's in the red.
You did. So we're going to get into them in just a moment. In the meantime, I think some interesting stories that we wanted to mention. It's city stories, and we're going to actually talk about the city's double issue of Business Week that's coming up. It's going to be out later this week. But speaking of cities, one on San Francisco, their streets are empty while nearby San Jose is booming. Not so far, but it's outside the city. So a tale of 2 cities within California, and very close cities.
Yeah, located in the heart of Silicon Valley, San Jose has added, San Jose's mall, the Westfield one, has added new stores, including a 3-story Eataly. You'll know about those if you live in New York. And a luxury wing with brands like Tiffany and Versace. The mall's sales have increased by 66% since 2019. Carol, this is in stark contrast for what happened in the heart of downtown San Francisco. With the struggling mall for San Francisco's Westfield.
Yeah, it's interesting, right? And we talk about this in San Francisco, that this contrast between these 2 cities that are, geographically pretty close to each other, right?
But it makes sense, given what's happened over the last 3 years,
right,
where people can work remotely. There's no need for these tech workers to actually go into San Francisco.
Yep.
So a lot of them moved outside of the city, and in its place, there's a lot of economic activity that's not taking place.
And I wonder if we hadn't gotten the pandemic, if we'd be talking about this story.
The economic centers of cities have shifted dramatically.
Yeah.
Like, I say this all the time, but I mean, my neighborhood in Brooklyn is as crowded on a Tuesday as it is on a Saturday with people frequenting the restaurants.
That's a really good point. And, we've talked about demographics in the U.S., people not moving around for a very long time, decades, and they're finally shifting around post-pandemic. Hey, another story, we don't have a lot of time to get into it, but we're just going to give you a little teaser. A Chicago TV crew reporting on robberies in a Chicago neighborhood got to experience the crime wave firsthand, basically robbed at gunpoint. I mean, you can't make this stuff up.
No, it's a Spanish language Univision Chicago station. They had a video camera and other personal belongings stolen, Carol.
Yeah, unbelievable. So read more about it at Bloomberg.com. All right, right now, we're talking markets. Beyond the Bell starts now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, Katie Greifeld and Shonali Bassett counting it down to the closing bell. here to help take us beyond the bell with the global simulcast. Joined now by Carol Masser and Tim Stenovic, bringing together all of our audiences, television, radio, YouTube, originals. And Carol, big broad rally on our hands.
Yeah, and it's sticking, right? We're seeing it pretty much hold here in the last few minutes of trading. Having said that, if you're looking for some outperformance, you know I go to an area that I like to go to, and that is the Chinese names that trade here in the United States. Really some outperformance. The Nasdaq Golden Dragon China Index up 3.7% here with just a few minutes to go. But we see China continuing to have troubles, but also take steps to ease those troubles and ease investor concerns. So deposit rate cuts they're considering to boost growth among the banks, and then they're also speeding up some fiscal spending to boost the economy as well. So every day, every 24-hour news cycle, bunch of China stories.
Everything is higher today, Carol, including all the cryptos on the crypto dashboard, despite the fact that the U.S. legal win when it came to Grayscale's ETF ruling just had to do with Bitcoin. Still, we're seeing Ethereum, XRP higher, Dogecoin. Katie, you remember that one?
No,
Okay.
I don't. Wiped from my memory.
I don't know if you heard about this Grayscale ETF ruling.
You know, I did hear about it.
Two of you. I don't know if you guys have been covering this all day.
I saw it somewhere on Twitter. I don't know.
I think I'm out of words, actually.
Well, as soon as I'm going to come back to this after the bells, because I'm really eager to hear what the two of you have to say about this, because
All right.
I know it's been a long time coming, Katie.
It's been a long time coming, but let's talk about the equity market right now because we are about 10 seconds away. You can see the S&P 500 going to finish close to its session highs, up 1.5%. NASDAQ Composite doing even better today as some of those big tech names rally, up about 1.8%. Dow Jones Industrial even getting in on the action. That index, Carol, going to finish about 0.9% higher.
All right, and digging a little bit deeper into the S&P 500, as we've been kind of joking around here, really hard to find decliners. That's because 446 names, so almost all of them in the S&P 500 are higher today. Just about 53 to the downside, and Shinali 4 unchanged.
Yeah, let's take a look at the sectors also because it looks like a lot of green on that screen. You're looking at the auto part of the S&P index, up more than 6%. Just take a look at what that looks like. You have semis up more than 3%, telecom services up more than 3%, media, entertainment, consumer durables, all up almost 2% or more. You only really have utilities, energy up only about 0.2% on the day. But again, a lot of green on the screen, very broad-based rally today.
All right, so let's get to some of the individual gainers. There were so many to choose from. I know Elf Beauty, it had its rally. Coinbase, we talked about, definitely jumping after that court decision. So I'm going to go to actually, once again, I talked about the Chinese names rallying here in the U.S. Check out PDD Holdings. It was up more than 15.5% in today's session, top among the NASDAQ 100. In fact, the #1 gainer in the NASDAQ 100. This is the owner of the hit shopping app Temu, so it definitely soared. Revenue rose a stronger than expected 66% after the company spent to boost growth at home and abroad to counter a bumpy post-pandemic recovery in China. And their growth, PDD's growth, surpassing many of its major Chinese tech peers. So really some outperformance there. Tesla, check that one out. It was a top gainer in the NASDAQ 100 and the S&P 500, up 7.7% on above average volume. Dow Jones noting that the company is launching a $300 million AI computing cluster today. This is according to an Oppenheimer analyst. So I don't know, supercomputer news. There was really hard. I couldn't really find anything specific, but take that for what it's worth. But nonetheless, Tesla shares were definitely moving. Best Buy, it was up about 3.9%. A top name in the S&P 500 reported better than expected comp sales for the fiscal second quarter. Analysts like some of the improving sales trends. And then you had Ginkgo Bioworks. That one was up 24% in today's session. The company coming out and talking about its partnership with Google Cloud, allowing it to develop and deploy AI tools for biology and biosecurity. So investors pouring into that one.
Did you guys notice that Carol has 4 gainers today?
I did. I was wondering about that.
I only have 3 decliners. She's like just rubbing it in like it was an embarrassment of riches of stocks that were higher today. Meanwhile, I had to, search far and wide.
Though, Tim, you found some names.
I found some interesting stories actually. The worst performers on a percentage basis in the S&P 500. A couple of truck and truck component makers, starting with PACCAR, Katie, down 2.7%. They make Kenworth, Peterbilt, and more on the trucking side. And then Cummins, they're the maker of truck engines, they're lower because a report from FreightWaves said that results from major trucking lender BMO showed a deterioration in the credit standing of its trucking customers. PACCAR finishing down 2.7 and Cummins down just about 1.07%. And then Norfolk Southern down 1.63% today. Late last night, they said a now resolved hardware-related tech outage on Monday would impact its rail operations for at least a couple of weeks. They successfully restored all systems at 7 p.m. Eastern Time yesterday. They said at this time, we have no indication that this was a cybersecurity incident, and they've been in contact with their customers. Are going to work to update the timing for their shipments, but shares lower after this news.
Seems like you had a theme today. Things with
Transportation.
wheels.
Things with wheels.
Yeah.
Do trains have wheels?
I think so.
Okay, we'll allow it.
I'm going to Google a
I'll
photo
allow
after this. Let's talk about the bond market, because once again, that's where all the action is, in a good way today. Actually, usually for the past month, we've been looking at huge sell-offs. Now you're seeing the opposite. Yields really taking a leg lower, especially at the front end. You take a look at 2-year Treasury yields down by almost 17 basis points, and that buying interest continued across the curve. But it was especially concentrated in the front end, of course, after that JOLTS data that we got this morning. It's going to be really fun to see what we get on Friday from the NFP report. But you add it all together, guys, we're looking at a bull steepening of the yield curve, that 2s10s curve at negative 77 basis points right now.
I mean, you just take a look at where we were yesterday on that 2-year at 504 relative today, back down to 488. And you take a look at that relative to the month, Katie, and we were up on the month about 491, I believe. So even the move that you saw to the levels you are today is lower than the average you've seen all month. And we still have not hit the key economic data points of the week, the PCE deflator and the jobs number. What a week ahead of us still.
This is just
the warm-up.
It makes you wonder what the real level is supposed to be, right? When we see kind of significant moves, we see the volatility, we've seen some significant moves, certainly in the Treasury curve. Like, what is really the bottom and top? Something that we kind of keep trying to figure out at this point. Should we get to some earnings?
We probably should.
HPE just crossing the Bloomberg terminal, and let's go right to the outlook. Fiscal year adjusted EPS 211 to 215. It had seen 206 to 214. Keep in mind that HPE did pre-announce, so a lot of this may have been already out there in the marketplace. Fourth quarter adjusted EPS 48 to 52 cents. So it looks like it's widening the range there. That for a beat, the estimate on the street is 50 cents a share, and the company looking at third quarter net revenue of $7 billion. The estimate was for $7 billion. I mean, that's because they pre-announced, like we knew what was happening.
Yeah, and you can see that not too much action after hours. Shares currently up about 1% post-bell. Of course, again, they did boost their full year adjusted EPS as the forecast, rather, as Carol said. A little bit of a lift. This is a stock that is kind of been muddling along this year through today's close, only up about 5.5% for 2023.
So the question is can it leverage all the excitement in AI that we've seen over the last few months? The CEO, Antonio Neri, also the president of Hewlett-Packard Enterprise, saying in a statement today, Shonali, quote, demand improves sequentially across all key business segments with particular strength in our HPC and AI segment as customers discover HPE's unique capabilities to power unprecedented levels of performance for AI at scale. Also talking about the strategic shift toward edge, hybrid cloud, and AI delivered through HPE GreenLake platform, and the fact that Neri says it's working.
Yeah, it's interesting to see the net revenue forecast come just in line with expectations, but also free cash flow. The estimate was $2 billion. They still see that will be $1.9 billion to $2.1 billion, so just in range to the point that you're making. This was a largely telegraphed release that we're seeing.
Yeah, no doubt about it. And don't forget, we're going to get HPQ a little bit later on this hour. I mean, that's a stock that's actually easily beating HPE this year. It's up about 17%. So we'll see what kind of results we get. It's, not apples to apples. They're different types of companies, Tim.
Okay, I just want to, we only have a couple minutes left, but I promised I'd come back to the landmark U.S. legal win for the Grayscale ETF, because both of you two have been covering this so closely. We had Hannah Miller on a little earlier in our program, and I asked her this question, Katie. Why are people so excited about this, given how easy it is for someone to buy Bitcoin just, using PayPal, for example?
That's the thing. And of course, I will note that this is just one step in the process potentially to getting to a spot Bitcoin US ETF. It's going to be interesting to see the SEC's response here. But Tim, to your point, this could easily turn into another sell the news event. I've talked to a lot of analysts who say that. If you take a look at what happened with the Bitcoin futures ETF in October 2021, those debuted. We hit an all-time high in November, and we haven't been anywhere close since. So how much left untapped demand is out there is really an open question.
The question of custody, not your keys, not your coin, all of that, I think is an interesting part of the discussion here, because how much safer is it to really be wrapped in an ETF versus just to buy the thing itself? I think that's another massive question. And really, does it just all of a sudden get all these wirehouses comfortable enough to start pitching it to their folks? I don't know. I mean, at the end of the day, it depends on what the incentive is for them to do that with the risk associated with it.
It's just like they got a little bit of a win, right? In terms of the crypto world that has been so beaten down, and that's why you've seen like all this euphoria. It'll be interesting to see what kind of follow through we have ultimately into tomorrow's trade. All right, guys, that's a wrap. Our cross-platform coverage on radio, TV, YouTube, and of course Bloomberg Originals, counting you down to the close on this Tuesday afternoon. We call it Beyond the Bell. We'll see you again tomorrow.
This is Bloomberg Business Week with Carol Messer and Tim Stenovec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on this Tuesday, talking a little bit of crypto and the market close with our TV colleagues. We want to continue a little bit with the HP story, because they are out. We're waiting for HPQ to report. As we said, HPE did pre-announce, so a lot of it was already laid out for investors. Having said that, we do want to get a little bit of some color, if you will, on the quarter, the outlook, and how this particular tech company, well known, around for a long time, kind of fits into our world.
Very pleased to have with us this afternoon Bloomberg Intelligence Senior Technology Analyst Woo Jin Ho, with us on Zoom from BI headquarters in Princeton, New Jersey. So good to have you with us this afternoon. The question I have is what in here was a surprise to you? What's new to you?
No, I mean, there's really nothing new here. They're pretty much
okay. I guess we're announced. Interview's over. I'm just kidding.
they pretty much pre-announced. But if we dig deeper into the numbers, actually, look, what's been white hot not only for HPE but also the rest of the tech sector has been the networking space, and the slight upside into the quarter was the intelligent edge. Right, that segment grew 50% on a year-on-year basis. Where it fell short, however, was on the compute space. There has been some concern that the server space is going to be weak, and they missed by about 3% versus consensus expectation, and that turned out to be true. We're still waiting for the server space to rebound, and it still may take a couple of quarters before we start seeing growth come back here.
You know, in an AI-obsessed world, how do we think about HPE specifically and where they fit in?
Yeah, I mean, they're actually trying to really position themselves very well in AI. Keep in mind that they have this high-performance compute division, which is going to drive some AI. The CEO, Antonio Neri, said at a recent investor briefing that they had about $800 million in orders. So that's a number that I'm really curious to hear on the call. But, you know, in the overall picture, they're still growing that AI business, but and also they have to get access to the NVIDIA cards to build these AI clusters for the enterprise. So it's going to take some time for that AI business to be a real business.
What is that AI business? Like, what does it look like? What do customers experience? And how much of it is done? I mean, how much of a value creater is HPE? You said,
Sure,
I mean, it sounds like a real winner is NVIDIA.
It's potentially, you know, a value creator over the long term. Near term, you know, $800 million in orders in a roughly $40 million revenue base, or 29 billion revenue base isn't going to move the needle anytime soon. But there's a couple of things, right? First, the enterprise customers do not have access to these NVIDIA cards where all the clouds are sucking them up. HP can actually come in there and provide as a service provider to build in-house AI systems for these enterprises. That's number one. Number two, HPE over the past several years has been moving over to this as a service business model. And with that, they've actually introduced a new AI large language model service to provide to these customers. So if there are customers who want to build out these large language models, do not have the wherewithal, they can actually rely on HPE. And among all the large enterprise vendors, enterprise IT providers, HPE is very far along relative to someone like a Dell or a Cisco.
Well, just as a reminder that when we speak about AI and the needs and the demands and who are the winners, there's going to be multiple ones. Is that safe to say, Woojin?
Well, right now, the big winner is NVIDIA, as we saw on last week's earning, right?
Right.
And when we think about AI in the early stages and think about AI house being built, the first thing that's going to be built is the plumbing. And NVIDIA is the leader there. One smaller name that I can share is probably Arista Networks, and they provide Ethernet networking, and they're probably going to try to fight the battle where NVIDIA is on the networking side. You know, if you talk about on a services perspective, the hyperscale cloud providers are probably nearer in terms of being revenue generating versus like meaningfully revenue generating relative to some of these enterprise IT guys.
Arista Networks is at 52% this year.
Wow.
Just sharing, yeah.
Woojin, who would be competitors when it comes to AI and where Hewlett-Packard Enterprise is really trying to grow?
Well, you know, the one benefit that HPE has is actually their Cray acquisition from several years back, and they've been trying to pivot that towards an AI play. So they know high performance compute really, really well, and they are starting to build out servers for enterprises to drive AI. Now, the one company that is trying to, there are two companies that are trying to move on the server side. One larger company is Dell. They're building out their own AI servers. A smaller company that I can share is Supermicro, and they've been delivering these high performance compute. And if you look at that stock price, I think has tripled over the past year because of they make these AI specific servers.
Yeah, up 218% this year alone. So yeah, it's been on a tear. It's about a almost $14 billion market cap company.
Supermicro.
HPE, nicely done. HPE is down about 0.4% in the aftermarket. Can we flip to HPQ? We're waiting for those numbers. It's definitely been outperforming its, former sister brother, whatever you want to call it, HPE.
Well, before you get into that, is it typical, Woojin, that these two companies report on the same day? This is surprising to me.
It's all legacy.
So do they always report on the same day?
They do.
Okay. All right, so they're former brother and sister, and they're still kind of related.
Twins. Yeah. Twins of So, okay, HPQ up about 16%. We used to call this was the old, right, Hewlett-Packard. What are you watching out for that one?
Yep. So I'm looking for the rebound on the PC market. It looks as if it's starting to flatten out in the calendar second quarter, their fiscal third quarter, and hopefully they'll talk about signs of a slow but steady recovery. I don't think it's going to go down any further, and I don't think they're going to stick their neck out and talk about growth anytime soon. But stability is where investors want them to be right now.
Does back to school help with PCs?
Well, what had happened over the past couple of quarters was that there was such an influx of PC production build that companies have overbuilt PCs, and there was an inventory correction. So there was a halt on PC sales. Back to school and a return to seasonal demand is going to help. Back to school plus the holidays.
And it looks like HPQ just crossing. I'm just going to throw some numbers at you, Woojin. HP Inc. sees fiscal year adjusted EPS of $3.23 to $3.35. Had seen $3.30 to $3.50. So it looks like it's bringing in its fiscal year adjusted EPS. Looking at fourth quarter adjusted EPS, 85 to 97. The estimate is 94 cents. Third quarter personal systems revenue, $8.93 billion. That is better than the estimate of $8.79 billion. And third quarter free cash flow, we're looking at $900 million. Estimate, though, is for more than $1 billion.
Yeah, and in the after hours shares, at least the knee-jerk reaction is lower, Woojin, down about 6.5%. What's your immediate reaction?
The reduction in guidance is possibly because of higher mix of PCs, because PCs did better. That means they have lower gross margin. The printing business actually has higher gross margin and operating margins because of the supplies business. The stability or better PC business is actually an encouraging sign.
It did say, I'm just going to it our right through real quickly, reducing its full-year cash flow and profit outlook, saying a rebound in the market for PCs will take longer than expected. So it sounds like a little bit more of the same that we've been expecting. Hey, thank you so much in real time breaking down those earnings with us. Woo Jin Ho, he's Senior Technology Analyst at Bloomberg Intelligence, joining us from BI headquarters in Princeton. We've been leaning on those guys a lot heading out to our Princeton Bureau today and our BI team. They are incredible. HPQ shares down 5.3%. Tim.
Yeah, we got more with our Bloomberg Intelligence team coming up later in the program as well.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. HP Inc. shares down after hours by roughly 5.5%. HP Inc. reduced its full-year cash flow and profit outlook, saying a rebound in the market for PCs is going to take longer than expected. Again, after hours, shares of HP Inc. down now by just about 5.5%. Hewlett-Packard Enterprise boosted its annual profit outlook, confident that businesses are upgrading technology despite concerns about the economy. Woo Jin Ho is a senior Bloomberg intelligence technology analyst, and he was interviewed about HPE moments ago right here on Bloomberg Business Week.
HPE over the past several years has been moving over to this as-a-service business model. And with that, they've actually introduced a new AI large language model service to provide to these customers. So if there are customers who want to build out these large language models, do not have the wherewithal, they can actually rely on HPE.
And HPE shares down now by about 0.8%. By the way, you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. The Dow, the S&P, NASDAQ all advanced today. Stocks climbed the most since June. Bond yields retreated after economic reports bolstered speculation that the Fed is getting closer to wrapping up its aggressive tightening campaign. S&P up 64, up 1.5%. The Dow up 292, up 0.9%. NASDAQ up 238, up 1.7%. 10-year yield 4.11% with a 2-year 4.88%. Gold up 0.9%, 1937 the ounce, and West Texas Intermediate crude up 1.4%, 81.19 a barrel. Cannot ignore Bitcoin today. Bitcoin surged 7.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it, Charlie. Thank you so much for that. Well, convincing everyone to adopt a new technology, it can be a bit of a slog at first. The humble microwave oven, which we all take for granted now, for example, took 2 decades of lukewarm sales to reach just 1/10 of U.S. households. And then came the 1980s, and Tim, quicker than you can say, Hot Pockets, microwaves that spread to nearly every kitchen. I wish they were
Have you ever not burned your tongue on a Hot Pockets?
That's the other story. That's coming out next week.
That's impossible. Well, the fast part of the tech adoption curve is happening now with electric vehicles. That's according to a Bloomberg Green analysis of adoption rates around the world. With more on the EV space and the significance of passing a threshold that signals the start of mass adoption when technological preferences rapidly flip, it's our weekly look at the EV space. We do it every Tuesday. With us, we got the host of Bloomberg Technology on Bloomberg TV, Ed Ludlow, on Zoom from our San Francisco bureau. Also with us is Tom Randall, senior reporter at Bloomberg News. He's with us right here in the Bloomberg Interactive Brokers studio. Tom, I want to start with you and just talk about this adoption curve, whether we're talking about the VCR, the microwave, the DVD, or the EV. Why is 5% such a crucial threshold?
Can we first say thank you for putting Hot Pockets in your story? Because those were your incredible words that we just borrowed.
My pleasure. Well, yeah, with any new technology, you have this adoption curve, right? Things start off really slowly at first, and then at some point it clicks with the mainstream. Maybe its costs have come down or the product has improved, and all of a sudden it clicks and everybody's got a microwave in their kitchen, right? And we knew that that was going to happen at some point with electric vehicles. But what we didn't know is the specifics of that curve. At what point in any given country do things actually take off and go mainstream? And also, like, how far does it go before things start to taper off? You know, some technologies don't get universal adoption. Like even the iPad or tablets, you know, aren't like the smartphones. You know, smartphones are everywhere. They're completely ubiquitous, but not everybody needs an iPad. And some people thought maybe electric cars might be the same. Maybe they only work really well for half of the people or what have you. So what we really wanted to do was to figure out the shape of the adoption curve. At what point does it start to happen, and how quickly does it happen once you reach that point? And we did that by looking at countries where it's already been happening. You know, Norway kicked things off like a decade before anybody else, and then, you know, Iceland and Sweden, and, you know, and now China, and now eventually the United States. And what we found is that right around 5%, that when 5% of new cars are electric, that's when things really start to take off. And, you know, there are a lot of reasons for that. You know, the challenges for electric cars are universal. You know, you think about why you might not want one.
Right.
You know,
they're just really expensive. But anyway, go ahead.
Yeah, well, that's one of the things, right? And costs have to come down on electric cars to a certain amount. Governments sometimes subsidize them, so cost is one of the things. Charging networks is another thing. You know, range anxiety is another thing. Like, are the ranges long enough? And once enough those challenges are solved for 5% for this full early adoption phase, then they're solved for enough people for it to really take off.
And so we're kind of there.
And we're there in the United States and in 23 countries total.
Ed Ludlow, come on in, because I will say anecdotally, I am seeing more EVs in my neighborhood when I'm on the road. Talk to us about this in this report that was written out by Tom.
You know, Tom's done two things that are really key. He's not just tabulated where we stand in each market globally for electric vehicles, but also linked it really closely to both macro and microeconomics. The lesson that I got from this wonderful story in the data analysis is that being the biggest market for something doesn't mean you're the fastest moving. So he talked about Norway. Norway's latest EV market share is 82%. And how they've tabulated that is not only to point out where it stands, but at the point at which it first hit the 5% mark, which for Norway was in the third quarter of 2013. The biggest markets for vehicles are the US, China, and India in that order. But as we know, US is behind China in terms of EV adoption. You and I talk all the time, Carol, and Tim, welcome back as well. You and I talk about it too, about how there are many more domestic players offering a wider range of options in China. That's reflected in the data we see now. The latest EV adoption in China is 16.8%, to the US is 7%. India is a really interesting one because it doesn't even register on the table right now, but it is the world's third biggest auto market. And there are both macro and microeconomic factors that will see its pace change. But one big factor right now is that India has catching up to do, and its automakers are investing to do that.
So Tom, go ahead.
Oh yeah, Ed, I'm glad you picked up on India. I thought that was really interesting as well. You know, I keep a track of different countries that are kind of approaching that 5% tipping point, and India was a real surprise to me this quarter. They had doubled their sales in the last 6 months alone, and they're up to about 3% now. And like I said, that threshold is kind of at 5%. And so, you know, India could be on the verge of a breakout here, and that would be years and years in advance of what most analysts and energy agencies think.
So, Ed, what's the takeaway for legacy automakers here in the United States?
Yeah.
The Fords and the GMs here in the U.S. that have invested so much into developing EVs, but at the same time, they have those cash cows of, you know, big gas-powered trucks.
Well, I'd quickly re-mention what I said a bit earlier about both macro and microeconomic factors, or another way of putting it, kind of rather than hard economic data, soft economic data. And as we said, we know the US is the biggest market for cars. The data point is that US drivers drive further and more often and a greater duration than any other market in the world, which meant that in the first instance, range anxiety was a much bigger problem here than it was for, say, for example, in Norway. I've been to Norway many times. It is an incredibly beautiful country. But most Norwegians are driving around their local, you know, suburb of Oslo, you know, for example. They're not
also,
driving
gas is the more expensive there than anywhere else in the world.
Right.
And so the other microeconomic factor, or macro in some sense, is the gas price that motivated them. Here in America, you know, what the big automakers had to do, and remember, Tom's data looks only at pure battery electric, not hybrid electric vehicles. But they had to manage a transition where what they offered was a transition from combustion engine to battery electric. Tesla, the market incumbent, only made battery electric vehicles, and so it's completely makes sense that they are the biggest seller of the world given their scale. That's all they ever did. Managing that transition's been hard for the big three in Detroit, and what they've done is the vehicles they have introduced that are battery electric, look at what kinds of vehicles those are. They play to brand loyalty. For example, the F-150 Lightning, F-150 a mainstay of Ford's business, but as a category to pick up, so important to Americans.
It's a really good point. All right, so I'm going to go. We have about a couple minutes left here. My concern is about the supply chain and being able to keep up with what's necessary to really see even further ramp up when it comes to EVs. Tom, what's the thinking, or what's your reporting finding on that front?
Well, I mean, that's one interesting thing about this kind of approach of looking at it, is it kind of ignores all of those issues, and it just says, look what's happened so far. And people have said that supply chain was going to be a problem all along the way. You know, even earlier on, like, you know, when Norway, who's going to supply Norway with more and more EVs? You know, it's a tiny market. But then there was a solution there, and there was a solution in China. And now we see even big rigs in China, their shipping has reached 5%.
But the miners can get all the needs to make all the batteries and so on and so forth?
That's a question. That's definitely an open question. And I think there's a lot of concern concern out there, particularly for lithium. There will be constraints on copper even. But, so far, there haven't been challenges like that capitalism has failed to solve. We know that there's an abundance of these resources in the earth, right? We just have to get them out. And if there's demand for that, we find a way. Humans are really good at that when there's the incentive there. And so far, they've done a really good job with that. And the Inflation Reduction Act last year put in a ton of money to expand that supply chain across the world, and especially in the United States.
Do any of us have EVs? Ed, do you have an EV, real quickly? Just go.
No, I've been really honest with you about this. I tried to buy one in 2022. The wait was too long, and my wife and I needed a vehicle for work. So we went with a gas engine, and I'll get one as soon as that lease is up.
And none of us, right?
I do not. I do on-street parking in Brooklyn.
Same. So take my catalytic converter.
I live in an urban environment too, just outside the city. There are Teslas parked on the street. It is
there are
crazy.
In our neighborhood too.
It is nutty. All right. Thank you guys. So wanted to do this story. Tom Randall, senior reporter at Bloomberg News. Ed Ludlow, co-host of Bloomberg Technology at Bloomberg TV out there in San Francisco. Tom right here in studio.
Let's get a check on the latest world and national news with Leslie Lotto in the Bloomberg 1130 newsroom in New York.
I have a GM Bolt, I'm just saying. The Red Cross is ready to help with Hurricane Idalia. Red Cross spokesperson Jonathan McNamara says the organization's been on the ground preparing for the hurricane's arrival.
So that's making sure we have the physical resources, the volunteers, and the materials to be able to establish emergency shelters, serve meals, provide disaster mental health care support, and be there for communities that will need us not only over the days to come, but the weeks and months to come as they start a recovery process.
He says they also still have people on the ground in Maui and could use volunteers. You can go to redcross.org to sign up. Speaking of that, crews almost done searching for bodies in Lahaina. Crews say that they have found 115 people have died. That's a confirmed number, but nearly 400 still considered missing. President Biden's taking a victory lap inside the White House to announce the first 10 drugs chosen for Medicare price negotiation under the Inflation Reduction Act. The chosen drugs, which treat a wide variety of conditions from diabetes to Crohn's to cancer, could save Americans billions once the savings kick in 2026. The president celebrated the move as the, quote, New Deal for the American patient.
Playing games and pricing so they can charge whatever they can. But this is finally, we had enough votes by a matter of one to beat Big Pharma.
And there's been a memorial service for mercenary chief Yevgeny Prigozhin, who was killed in a plane crash last week. In a terse statement on social media, his spokespeople posted, those who wish to bid their farewell to the 62-year-old mercenary leader should report to the St. Petersburg Cemetery. Global News 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. Best day for the U.S. stock market since June, with the S&P up 64 points. That was a gain of just about 1.5%. Dow Industrials up 292, up by about 0.8%. NASDAQ up 238, up 1.7%. Broad-based rally today. Russell 2000 up by 1.4%. 10-year yield 4.11%, with a 2-year that's yielding 4.89%. Gold up 0.9%, 1937 the ounce. Bitcoin surged today to 27,710, and West Texas Intermediate crude up 1.6%, 81.36 a barrel. Lots of earnings after the close of trading. Hewlett-Packard Enterprise shares are now lower by 4.5%. It did boost its annual profit outlook, confident that businesses are upgrading technology despite ongoing concerns about the economy. HP Inc. reduced its full-year cash flow and profit outlook, saying a rebound in the market for PCs will take longer than expected. Shares are declining now by just about 5%. Job openings fell by more than expected to 8.83 million, a more than 2-year low, offering fresh evidence that labor demand is slowing down. Nicole Webb is Senior VP and Financial Advisor at Wealth Enhancement Group. And right here on Bloomberg Business Week today, she said the JOLTS data this morning was a catalyst for today's move higher.
Some of the deterioration in jobs is meaningful, and I think you couple that with this pressure on return to work, which is showing a little bit of a nuance from a business perspective of we're not as fearful to lose you as we once were. So if it's a deal breaker for you to come to the office, that's okay with us. There's available workers out there that we'll go grab.
And you can hear more of that conversation on the Bloomberg Business Week podcast, recapping S&P up 64, up 1.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet there with a Bloomberg Business News Flash. Carol Massar along with Tim Stanovic live here on Bloomberg Business Week. So we've got a couple of stories playing out when it comes to New York City right now. First up, New York City business leaders are urging Congress and the Biden administration to provide more money to deal with a flood of 100,000 asylum seekers straining local coffers. And this was an open letter to President Biden and congressional leaders. Today, the Partnership for New York City writing, the situation is overwhelming the resources not only of the border region, but of city and state governments across the nation.
Yeah, some familiar names certainly signing this letter. The co-chairman of the Partnership for New York City is Pfizer CEO Albert Bourla, Tishman Speyer Property CEO Rob Speyer. They were joined by dozens of other local CEOs, including JP Morgan's Jamie Dimon, Larry Fink from BlackRock, Henry Kravis from KKR, among others. Let's get into it with Laura Namias. She's New York politics reporter at Bloomberg News. She joins us right now in the Bloomberg Interactive Brokers studio. The Partnership for New York City, Laura, this got a lot of attention during the COVID crisis as well, with like return to work, getting people back into the city. How much power does it have? Like, do people listen when they speak?
Absolutely. The partnership has been around for a long time, and its leader, Kathy Wild, is incredibly influential in business and politics in New York City. And so the partnership's opinion is usually seen as sort of a consensus opinion of the most well-respected and important businesses in New York City. Whether or not that has any impact on the Biden administration and Congress in this particular case, though, is really an open question, because this is such a thorny political issue for the Biden administration and for New York City.
It's always complicated. It's like this. But something needs to be done. Immigrants need to be taken care of, right? Absolutely. Or migrants need to be taken care of. What kind of numbers are we talking about in terms of the costs?
Well, in terms of the costs, the New York City Mayor Eric Adams' administration is estimating that this is going to cost the city of New York alone $12 billion from last spring up through July of 2025. That's an extraordinary number. We're talking about an annual budget in New York City of somewhere around $106, $107 billion. When you think about the additional unexpected cost that taking care of the migrant populations represents, it's just more than the city thinks it can manage.
Where's this money coming from?
It is coming from state funds, state aid in small amounts, and also from city tax revenue generated by the citizens of the city of New York.
But when we have the whole pie for New York City and the services that it provides to its residents based on tax revenue, what's getting smaller as a result of this $12 billion that's going out? Do we know?
Well, at the moment, not much. There were some fights in the most recent budget cycle about cuts to potential library hours, to various city services. But the Adams administration is warning that in the future there may be less spare cash to go around, and that other things may face cuts.
Hey, one last question before we pivot to something else. But I mean, the other thing is expediting the process to allow them to work, right? That would start to change the situation, one would guess.
Yes. So the city business leaders in the Adams administration are saying that having so many new people coming into New York City can be a good thing economically for the city of New York.
Has anybody seen the job market?
Exactly.
How tight it is?
Allowing people to work, allowing people to contribute meaningfully to the economy, which is what many of the people who are arriving here say that they want to do, would be a great thing for everyone. And they're just asking the Biden administration to help facilitate that. It's easier said than done, I think the Biden administration would say.
We said at the top about different things. It's complicated. So many issues are. Speaking of the New York City economy, there are weed shops.
The proliferation of these stores over the last 2 years, you've walked by them, Carol.
I have.
Sometimes they walk by like trucks that are selling weed, and it's like out in the open, and they're not actually like selling it. They're just like allowed to. It's very weird.
Yeah.
It's had an unexpected consequence for banks and real estate owners. Many are now intertwined in the cannabis business. Another story.
Who thought this was going to happen? I mean, come on.
Of
course it was going to happen.
Well, I don't think that the policymakers who legalized marijuana in 2021 at the state level thought that this was going to happen. They had arguably the best intentions. They wanted to create a process that would allow people who were harmed by the war on drugs to be the first people to benefit from the ability to make money off of selling legal marijuana. However, they legalized the product in 2021 and then took almost 2 years to set up a system by which people could legally sell it. In the meantime, we had a pandemic that destroyed a lot of retail outlets and created an opportunity for unlicensed marijuana sellers to move into storefronts all across the city. There's an estimated 2,000 of them across the 5 boroughs and at least 450 of them in Manhattan alone.
Is this stuff just tolerated, though? I mean, unlicensed used to mean like, okay, you're unlicensed, so you can't do that. If you're an unlicensed driver, you're not supposed to drive.
Right. Well, it's complicated. There are very few laws left on the books at the state level that make possession or sale of marijuana criminal in any way. So there's an elaborate legal process that the city and state have to go through in order to try to evict an unlicensed marijuana seller. And in the meantime, the sellers are sort of operating with impunity.
So basically, you've got landlords who have unlicensed weed shops, and then you guys did an analysis.
Yeah.
And then you got J.P. Morgan Chase & Co., Signature Bank, and New York Community Bank had at least 25 mortgages to pot shop landlords, according to public records.
Yes.
And so, we don't know who knew what, right? But nonetheless, you have this illegal stores exposing the financial community in a big way.
Right. So marijuana is still illegal at the federal level, even though it is legal to use at the state level in more than 25 states, I believe, at this point. And so that exposes the landlords who de facto have these unlicensed pot shops in their buildings and their mortgage holders, these large federal banks in some cases, to all of the liability that entails when you have an illegal operation happening in a storefront.
I'm going to have a grandchild before they figure out the financial system.
Before the Safe Banking Act passes?
Yes.
Yeah,
This is crazy, right? How long we've been talking about it.
Yes.
All right, covering all things New York. Yeah, it's complicated. All of it's complicated. Weed shops, unlicensed ones, and dealing with all of the immigrants coming in, the asylum seekers.
Fortunately, Laura Namias is on it.
I wonder if it'll come up on the debate stages.
Maybe the migrants.
Maybe the migrants.
Yeah, definitely.
Thank you so much, Laura. We really appreciate it. All right, you are listening and watching Bloomberg Business Week on Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Best Buy said a painful sales slump in consumer electronics and household appliances is starting to show signs of easing. The retailer said this year is likely to be, quote, the low point in tech demand. Today we did see shares of Best Buy up by just about 2%. Cosmetics maker e.l.f. Beauty has agreed to acquire drugstore skincare brand Naturium for $355 million in cash and stock. Today, e.l.f. was up by 9%. With more on the e.l.f. story, here's Bloomberg's Kimberly Adams.
Charlie, the deal is expected to double Oakland-based e.l.f.'s share of retail sales in skincare to about 18%. e.l.f. and other mass-market brands have done well as consumers start to spend more on makeup in the post-pandemic era, but remain eager for bargains amid high inflation. e.l.f., which stands for Eye, Lip, and Face, has pared its low prices. Most items are about $6 or less, with a pledge that its products are clean and vegan without animal testing. That's helped the brand win over Gen Z consumers. Charlie?
And that's Kimberly Adams reporting. Verizon and AT&T both advanced today after Citigroup upgraded the stocks to buy, saying it sees a more constructive investment case for large-cap telecommunications firms. Shares of Verizon today gained 3.4%. AT&T today was up by just about 3.9%, while shares of T-Mobile US also advanced today by 1.1%. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on radio, on TV, not on TV. We were on TV.
Yeah, it's everywhere. If you have your TV
YouTube.
connected to YouTube, then it's on TV.
Exactly.
If you're using the Bloomberg Originals app and watching us on Roku, then it's on TV.
Very
Thank you.
nice. Ari, don't be mad at us. Can I go to...
No, we got to do some news, Carol.
Oh, we got to do news
Yeah,
first.
let's
Okay,
get a check on the
we'll give
latest
Ari
world and
a heads
national news. Leslie Lotto is patiently standing by in the Bloomberg 1130 newsroom. Hey, Leslie.
That's right. Carol and Tim, Floridians are getting ready. Windows boarded up, sandbags piled high along Florida's Gulf Coast as the state prepares for what's expected to be the season's first hurricane to make landfall in the U.S. Hurricane Idalia, expected to strengthen into a possible Category 3 storm before making landfall on the Big Bend region sometime tomorrow morning. With final preps underway and power outages guaranteed, Governor Ron DeSantis reminded those who use generators should only use them indoors.
It's got to be outside your house, 20 feet away from doors and windows, and the exhaust needs to be pointing away from your house.
Oops, I read that wrong. The governor has issued a state of emergency for 46 counties. The University of North Carolina grad student who was accused of killing a faculty member is being held without bond.
The suspect is facing felony charges of first-degree murder and possession of a firearm on educational property.
UNC Police Chief Brian James there. He says that Tai Lei Chi made his first court appearance today. Yesterday's deadly shooting at the university triggered a campus-wide lockdown lasting 3 hours. The faculty member who was killed was Chi's academic advisor. Chi's next court appearance is set for September 18th. And Buffalo Bills safety Damar Hamlin's made the cut. The AP reports somebody with direct knowledge of the situation said the Bills chose Hamlin in their final cut of 53 players. The NFL Network also confirmed it. Hamlin, whose bid to resume his football career is nearly complete after that near-death experience during a game at Cincinnati in January. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto, and this is Bloomberg. Back to you, Carolyn.
All right, Leslie, thank you so much. Carol Massar, along with Tim Stanovic, we've given our producer, Ariel Agami, a heads up because we really want to do this story. He talked about it. He's like, can we do this story? And I was like, I don't know.
Hey, believe it or not, a lot of planning goes into this program, everyone.
Yes.
Okay? So if we veer off script, if we go off course,
if
heads roll in the control room.
If it sounds messy, it's just us screwing up the well-engineered plans. We did want to get to a story that is actually the Bloomberg Big Take today. So it's an exclusive. It is the most read story in the Bloomberg in the past 8 hours. The headline is Citadel vets 69,000 intern applicants to find the next math geniuses.
I just got to read right from this, Carol, because it's so perfect. In a hotel ballroom overlooking the South China Sea, 24-year-old Taylor sits with 13 other university students in hoodies and sneakers, coding away on laptops.